about how fragile our banking system could be, and as a result, your banks only got even more powerful. So it's fair to take stock of how you're using that power. I appreciate the long overdue increases in wages and benefits for many of your frontline employees. Thank you for that. At least one of your banks has made real efforts to get rid of overdraft fees. Thank you for that. But your banks need to do far better when it comes to meeting customers where they are in recognizing their dignity of work, your employees and your customers. You should be cutting prices for consumers, increasing opportunities for your employees, increasing diversity with your executive ranks, supporting your workers' efforts, if they so choose, to unionize. And you should stop pouring money into lobbying against efforts to protect taxpayers who in the end subsidize your entire industry. The reason for this hearing every year is to hold the biggest banks accountable to the American public. I thanked each of you for being here a moment ago personally. I appreciate you're all coming together for this hearing. We want to hear from you. What will you do to support workers, to invest in the real economy, to finally put Wall Street to work for Main Street? Senator Scott.
Thank you, Chairman. And thank you to a very long list of CEOs who've come to talk with us about how the impacts of our regulatory environment will impact everyday consumers. And I hope that you all, some of the things I will say will be redundant because some of it's unprepared based on what the chairman just said, but I hope you all will really answer the question. Nothing in these proposals will stop your banks from lending to small businesses or first-time home buyers. Because if the proposal is Basel III endgame, who in America knows what Basel III endgame really is? Let's translate that for the average American sitting at home watching this because they have nothing else on TV to watch. It is simply requiring more capital on the sidelines, which then means fewer dollars to lend to small businesses, first-time home buyers, car loans. So the actual impact of a higher regulatory standard is fewer dollars to lend to Americans who need desperately to be engaged in the process of achieving the American dream that is typically defined by having access to capital. If you work really hard, and keep your life in order, you can have a good, quality, middle-class life. But if you want to actually experience wealth in America, you have to experience the benefits of profit or equity. Equity comes from having capital. Having capital typically means you either have it because you were born with it or you have access to it because you have an idea or a vision that will make your community or this nation better. When that happens, you go to a lending facility, called a bank or outside the market, and you find that capital that allows you to start your business. And as you start your business and it appreciates, it creates a profit, and that profit allows you to experience the upper echelon of the American dream. If you have a home, you look at the differences between African Americans and majority population and net worth, tenfold difference. Much of that difference is found in the profit or the equity in a home. So when we think about the proposals, not of good regulation, but of a nightmare proposal called Basel III Endgame that would put so much more capital on the sidelines, we should ask ourselves, how does that translate for the average American living and working paycheck to paycheck? My thought is it has a devastating impact to access to capital that makes the American dream harder to achieve, and access to capital for some folks who started where I started, virtually impossible. I think if you think about today's hearing from my perspective, I want to talk about three things. Number one is certainly Basel III, the end game. Number two is the burdensome regulations and guidance that will ultimately hamper consumer choice. And number three, the job our regulators are doing, or frankly should be doing, and the workplaces our regulators cultivate. I'll start, as I just did with Basel III, the end game. The fact of the matter is that this one proposal could have a devastating impact on small businesses, and I would like for you all to address that either now or during the questions. Last month, I led a letter to the FDIC, Fed, and OCC calling on them to withdraw this misguided proposal because American families, the folks who will bear the burden of this burdensome regulations, simply can't afford it. The letter was signed by nearly 80% of my Republican colleagues. that really spanned the entire ideological spectrum and the country. Nearly every single person who signed the letter did so because they all agreed that costly, harmful impacts on our constituents, our businesses, and their families is something that could be avoided if simply the banking regulators would listen to common sense and withdraw the proposal. And frankly, last month when the regulators spoke, even some of my Democrat colleagues agreed with our concerns on the negative impacts brought to us by a burdensome regulatory environment. Let me be clear, this proposal could limit, and frankly, I think will limit the following: availability of credit for housing for those who need it most, severely restrict lending for small businesses that are still rebounding from the pandemic, and cut into the retirement savings for hardworking Americans like teachers, police officers, firefighters, when they're dealing with higher prices and runaway inflation brought by the radical left. These are very, very serious and real concerns. But Americans shouldn't just hear about the concerns from those of us who are senators. We should hear from those who actually run the institutions that they have entrusted and have confidence in. As a former business owner myself, I believe that you all, as the day-to-day operators of these businesses, not elected officials, have a better sense of what the communities are facing, and the challenges brought upon the communities by these higher standards. Vice Chair Barr last month said that the new Basel endgame will only impact about 40 of the banks in our country. Said differently, 2/3 of all the loans processed will be negatively impacted by the endgame proposal. That's $60 billion in small business loans in 2021, $250 billion negatively impacted, and the definition of negative, higher interest rates or fewer loans. In 2022, in my home state of South Carolina, that translates into $550 million of small businesses having higher interest rates or fewer loans, and $3 billion in 2022 in home mortgage originations. If regulations continue to increase the costs of providing a loan, I fear that banks will decrease lending, not only in my home state, but across the country. Decreased lending means increased financial hardship, and increased financial hardship means a reduction in opportunity. That's my ultimate concern: reducing opportunity for everyday Americans. At the end of the day, these consequences will create a ceiling for low-income Americans, and it won't be a ceiling made of glass. Instead, it will be made of concrete. We simply can't let that happen. The second item I want to discuss with you all today concerns the onslaught of rules and proposals targeting your institutions and the banking system writ large. For instance, in recent months, we've seen proposals or final rules all the way from climate risk management to the Community Reinvestment Act. None of these proposals exist in a vacuum, and it is vital that this committee hear from each of you about the overall impact on the health of our economy. In particular, I'm deeply concerned by the continued partisan attempts of this administration to advance their climate goals by any means possible, including through our banking system with the recent climate risk management guidance. Banks have been considering weather risks for decades, and you should. It's called common sense. And it remains incumbent upon each of you to base your lending decisions on risks you can reasonably assess, like weather or credit risk, not, however, perceived political, rhetorical, or reputational risk. Beyond the explicit cost of these proposals, which ultimately are passed on to consumers, I fear that the only real accomplishments of the regulators will be to push more activity outside of the regulated financial system, where we have less insight into the impacts on consumers. And finally, number three, we must emphasize and turn our attention to the performance of our regulators and their core mission, the supervision of your banks and the stability of our financial economy. This past spring, We saw the failures of several banks, which shook consumer confidence. Since then, there's been nonstop finger-pointing by our regulators. In the aftermath of the failures, I was critical of the failed bank executives because that's where the dollar should stop. The buck stops with the executives. But you can't see that in a vacuum. You have to ask yourself the question, what was the role of the regulators? What did they do? What did they see? How did they respond to that? Your institutions have teams of examiners from the regulatory agencies in your offices every day, and I can tell by your faces you're really excited to see them when they show up. But the truth is that we, the American people, deserve to understand the complexity of the web that exists that makes the headwinds real for lending money to would-be entrepreneurs or first-time home buyers. Let me close with this. We're not on the same page on a lot of issues. I think there are times when banks go too far in getting involved in politics. But when it comes to your objective of creating access to credit, to resources for the American people and the American dream, that's where I hope we find our attention today, focused on an environment that is either easier for the average American to experience the American dream, or it's made harder because of the challenges brought to them by this government.
Thanks, Senator Scott. I'd like to introduce our 8 witnesses, and then I'm going to ask you each to stand and raise your right hand and swear you in. Charles Scharf, CEO and President of Wells Fargo, welcome. Brian Moynihan, Chair and CEO of Bank of America, welcome. Jamie Dimon, Chair and CEO of JPMorgan Chase, welcome. Jane Fraser, CEO of Citigroup, welcome. Ronald Hanley, CEO of State Street, welcome to you. Robin Vance, CEO of BNY Mellon, thank you for joining us. David Solomon of Goldman Sachs, CEO. James Gorman, CEO of Morgan Stanley. Please stand for a moment and raise your right hand. Do you swear or affirm that the testimony that you're about to give is the truth, the whole truth, and nothing but the truth, so help you God? Thank you. Make sure you take your seat, and Mr. Scharf, please begin.
Chairman Brown, Ranking Member Scott, members of the committee, thank you for the opportunity to be here today. I look forward to talking with you about the contributions Wells Fargo is making to support our customers, communities, employees, and to ensure the banking system is strong and resilient. In March of this year, we all saw the failure of several banks rapidly create instability in certain parts of the banking sector. Though the causes were specific to the institutions that failed, markets became concerned that the issues were broader. In response, Wells Fargo, along with other banks here today, stood as a source of strength and stability. The strength of our institution allowed us to lend support to a smaller bank in a time of need. These actions helped stabilize the banking system, ease consumer concerns, and keep a challenge from becoming a much broader crisis. I'm proud of the role we were able to play. Wells Fargo's strength comes from a strong financial profile, disciplined financial risk management, and a commitment to run our business with high standards. Our top priority continues to be building and running a well-controlled company. Over the past 4 years, we have simplified our business model and have exited or downsized several businesses. We are primarily a U.S. domestic bank, and we do not have many complexities that running large-scale international businesses brings. Our legal entity structure and physical footprint are far simpler than many of our competitors. Approximately 90% of our revenues come from the United States. We proudly serve 1 in 3 U.S. households and more than 10% of small businesses in the U.S. We are a leading middle market banking provider here. We maintain one of the largest branch networks in the nation, and we have more rural branches than any other large bank. Nearly 30% of our branches are in low or moderate income census tracts. We are constantly improving how we serve our customers and our communities. We're investing in our branches, we're building digital capabilities to complement our physical presence, and we are investing in the products we offer to our customers. Since 2019, we have taken numerous steps to reduce and simplify fees, which as of year-end 22 have resulted in average consumer deposit account paying approximately 25% less in fees per year. We give customers the choice of an account that offers overdraft protection or one that is not subject to overdraft fees. We eliminated non-sufficient fund fees and transfer fees for customers enrolled in overdraft protection. We introduced early payday, which makes eligible direct deposits available up to 2 days early. Extra day grace, which gives eligible customers an additional business day to make deposits to avoid overdraft fees. And Flex Loan, a new digital-only small dollar loan. I'm also proud of the role we play in our communities, where we seek to have broad impact. Last year, people who work at Wells Fargo contributed over 700,000 hours of volunteer service. I've spoken in the past of our decision to take the $420 million in fees we received from administering the PPP program and donating them through local partners to small businesses in need. Through the first half of 2023, these funds have helped support more than 203,000 small businesses, the majority of them diverse-owned, and helped preserve or create nearly 254,000 jobs. Finally, we believe our employees are our greatest asset. We invest in them and we listen to them. Since 2019, we have increased wages for U.S. hourly employees by nearly 20% and increased the average pay rate for tellers by 34%. In 2022, we increased the minimum base pay for more than 40,000 employees, and we invested an additional $200 million in employee development. We have several ways for employees to share ideas or voice concerns. Their voice matters. We take their feedback seriously, and we act on their comments. For example, in our consumer bank, approximately 4,000 improvement ideas that our employees have submitted this year have been implemented or are in the process for future implementation. Engaging directly with our employees in this way is critical to improving the work experience at Wells Fargo. I want to close by thanking our employees. Their dedication is unmatched. I'm thankful for all that they do, and I remain committed to leading Wells Fargo to being one of the most respected financial institutions in the country. Thank you, and I welcome your questions.
Thank you, Mr. Moynihan. Welcome.
Chairman Brown, Ranking Member Scott, and distinguished members of the committee, good morning. I'm here once again to proudly represent my 212,000 plus Bank of America teammates. Today, I'll provide an update from last year on how we deliver responsible growth for our clients, our teammates, our communities, and shareholders every day. Responsible growth continues to deliver strong results during times of relative calm, as well as during challenging environments like we experienced earlier this year. We saw market turbulence as a limited number of financial institutions faced challenges due to their unique business models. Bank of America, as we did during the pandemic, along with my colleague companies, served as a source of strength and stability for our industry and for our customers during these times. And we did this all while continuing to strengthen our balance sheet. As a G-SIB, we are subject to the highest capital and liquidity requirements, and all of our metrics exceed those requirements. And while we have declared that we have the capital today to meet the proposed new capital rules, we remind you that in recent years, including this one, have shown just how important it is to have these institutions be able to position their balance sheets to help customers and clients in times of stress. That's why we continue to play an active role to help inform the future of this industry, including comments on the proposed Basel III capital rule. We believe the capital accumulated by the industry should continue to serve the customers in America's economy, not be subject to regulatory capture by a theoretical model. The $30 billion in excess today at Bank of America should be used to grow the U.S. economy, to support the business plan of small businesses and medium-sized businesses, to help consumers buy a home and recognize the American dream. And now for a few specific examples of progress on responsible growth. At Bank of America, we serve 60 million American consumers, 11 million small business clients, and tens of thousands of commercial clients. We continue to focus on delivering expert network and guidance across our high-touch physical network. We ended the year with 3,900 financial centers and 15,500 ATMs. We opened 58 new financial centers last year and renovated 784 more of them. In addition to these branches, we have tens of thousands of teammates in serving over 100 local markets around the country. Over the next 4 years, we're expanding to Omaha, Louisville, Boise, Birmingham, Madison, New Orleans, Milwaukee, Dayton, and Huntsville. This will enable us to bring our full range of services and solutions to better serve clients and help drive local community growth and development. We also deployed our strength to low and moderate income customers, including approximately $9 billion in LMI loans to small businesses in 2022. In addition, we provided nearly $8 billion in debt and equity financing, creating more than 10,000 units of affordable housing. And we've committed $15 billion to our affordable home ownership program. That will help 60,000 American families purchase a home to ensure the American dream. Over the last few years, we've also invested in 24 minority deposit institutions. We have $2 billion outstanding to CDFIs. We've helped seed more than 150 private equity funds run by women and diverse private equity entrepreneurs. Our clients also continue to look to us to help them achieve a transition to a secure, low-carbon economy. With tens of trillions of dollars in investment needed over the next 30 years, this transition creates significant opportunities for our clients and for our company. This transition has to be led by the private sector, or it simply is not going to happen. Within our company, we continue to invest in our teammates' physical, emotional, and financial health. This includes taking steps to continue to move to our $25 U.S. minimum wage hourly wage pledge, which we increased to $23 in October. And for the 12th year in a row, U.S. teammates earning less than $50,000 annually will not see any increase in medical premiums. For the 6th year in a row, our teammates receive special sharing success bonus, generating equity ownership to over 200,000 teammates. We're a great place to work, as recognized by external parties and by our teammates. Our employee satisfaction scores remain at all-time highs, and our turnover rate is approaching an all-time low. Responsible growth also means supporting the communities where we live and work. In 2022, we made $360 million in philanthropic investments. Our teammates reported nearly 2 million volunteer hours for the year. We also create opportunity in our communities through employment. We're in the second leg of a 10,000 teammate hiring. That's 20,000 total from low and moderate income communities to work in our company. Similarly, we've hired over 15,000 veterans in the last 8 years. And importantly, responsible growth delivers for our shareholders. We have delivered strong earnings and strong returns. We continue to increase our common dividend, and we continue to return capital to shareholders. This is driving responsible growth. This is American capitalism at work. Thank you.
Thank you, Mr. Moynihan. Mr. Dimon, welcome.
Thank you, Chairman Brown, Ranking Member Scott, and members of the committee. I appreciate the opportunity to talk about JPMorgan Chase and the role of America's largest banks in supporting our economy. The United States has the best financial system in the world, where retail banks, investment banks, asset managers, investors, hedge funds, and non-banks serve the American economy. The country benefits from thousands of banks and credit unions of all sizes, covering all corners of our country. I'm very proud of this company and of the more than 300,000 employees worldwide. In the U.S., we serve more than 80 million customers, 6 million small businesses. We have more than 4,800 branches now in 48 states, almost all of your states here, and Washington, D.C., which puts a Chase branch within a 10-minute drive for 60% of the population. We are a top lender in every rural state, serving medium and large companies, local governments, hospitals, universities, farms, and manufacturers, providing almost $100 billion of credit and capital to clients in rural and small towns. JPMorgan Chase extended in total $1.7 trillion in credit to consumers and corporations in 2023. We moved $10 trillion around the world every day in 120 currencies and 160 countries daily, and we safeguard more than $29 trillion in assets. The country benefits from thousands of banks and credit unions of all sizes serving all corners, and we must acknowledge that there are some things that can only be done by large and complex banks, things that are essential to a thriving U.S. economy and American competitiveness. While we are a large Main Street bank, large banks in this panel serve America's interests overseas. We bank America's largest multinational corporations around the world. We bank other banks and financial institutions, such as mortgage finance companies, insurance companies, the World Bank, IMF, community banks, MDIs, CDFIs. Large American banks support the deepest, transparent, and most liquid capital markets in the world. We underwrite large and complex municipal bonds, which provide governments financing for roads, bridges, schools, hospitals, and airports. And we help Americans and small businesses manage their money and finance their dreams. Our collective work is important in good times, but essential in troubled times. In good times, large banks help America save, invest, and grow. We underwrite stocks and bonds to create investments for retirees and other savers and raise money for companies, fueling job creation and new business development. As guardians of the financial system, we support our government and national security to combat financial crimes and to carry out complex operations. We are a force for good for the country, its citizens, and the global economy. In troubled time, large banks provide market stability to protect customers and employees alike. As demonstrated recently during the spring 2023 regional bank turmoil, large banks stepped in to provide market liquidity, which protected consumers, retirement savers, and employers. During COVID, we also saw America's large banks provide significant support, extending tens of billions of dollars of credit and capital to struggling large and small businesses, local governments, universities, and hospitals at a time when they needed it the most. Banks waived hundreds of millions of dollars in fees and postponed loan payments for customers struggling to make ends meet. Despite zero evidence that U.S. banks are undercapitalized today, the proposed Basel III Endgame rule, 10 years in the making, shockingly, if enacted, would increase capital requirements by about 25% for the largest banks. None of these proposed changes, by the way, would have effectively prevented the Silicon Valley Bank failure. The rule would have predictable and harmful outcomes to the economy, markets, business of all sizes, and American households in ways the Federal Reserve has not studied, contemplated, or shared. Mortgages and small business loans would be more expensive and harder to access, particularly for low to moderate income borrowers, as costs for originating and securitizing loans rise. Savings for retirement or college will yield lower returns as costs rise for asset managers, money market funds, and pension funds. Government infrastructure projects will become more expensive as capital requirements for market activities will more than double, translating to higher costs to build hospitals, bridges, and roads. From beverage companies that need to manage aluminum costs to farms that need to protect against environmental risks, if the cost of hedging these risks increases, everything from a can of soda to meat products will be impacted. Ironically, a proposal meant to mitigate risk will actually increase risk. This rule will result in an increased shift away from regulated markets to less regulated markets, which was not also studied, by the way, and this activity will be out of the sight of regulators unable to see the next crisis brewing. I fear that the proposed now, study later is becoming a troublesome new theme in Washington. There have been a number of consumer-focused products, caps and late fees or interest rates, cuts to debit interchange, to name a few, where virtually no economic analysis has been performed to determine the individual or collective impact of these rules in consumers, small businesses, lower income families, markets, or the economy. The debate should not always be about more or less regulation, about the right regulations to keep America's banking system the best in the world. I urge lawmakers and regulators to be thoughtful about the effect of arbitrary and unstudied regulatory proposals and their cumulative impact on the economy. Good regulations and good regulators are critical to maintain the strength of our banking system. Our nation should give thanks to Chairman Powell and Secretary Yellen for their tremendous work through some complicated economic times, including their work on sanctions following Russia's invasion of Ukraine and the steps they took during the regional bank turmoil this spring. These are excellent examples of how regulators working with the industry, collaboratively, sharing information transparently, can protect the financial system and the country. To close, I'd like to speak to my 300,000 employees, and actually maybe all bank employees around the world, about how I am proud of everything they do every day in hundreds of communities around the world, serving consumers, businesses, large and small, farms, cities, schools, states, hospitals, around the clock, 24/7. Thank you very much for the great things you do for this country.
Thank you, Mr. Ms. Fraser. Welcome.
Chairman Brown, Ranking Member Scott, and esteemed members of the committee, thank you for the opportunity to speak to you this morning. As CEO, I have the opportunity to lead a 211-year-old institution that supports clients in nearly 160 markets around the world, and we have 240,000 employees, of whom I could not be more proud to lead and more grateful to. Through decades of geopolitical shifts and technological advances, we have seen how the US banking system is truly unmatched. The isolated bank failures of the spring may have tested the confidence of our people in our industry, but I am proud of how our industry, including my peers sitting around me today, how we came together and worked with the government to affirm the underlying strength and stability of the system. As we chart a path forward, we need to make sure we don't inadvertently upend the very system and unique system that we have. Our financial system is the envy of others because it is underpinned by the most competitive banking system and the deepest capital markets. We're home to banks of all sizes, each with an important role to play. Collectively, our banks serve as the engines of growth, supporting businesses and households and promoting access to financial services in hard-to-reach communities. For American multinationals, global banks such as ours offer the size and scale to help them compete overseas without having to rely on foreign banks. We finance supply chains and partner with Americans' top companies to bring products and services to American consumers at affordable prices. We use our robust balance sheets to fund transformational projects. Last year alone, Citi worked with state and local governments to raise or finance nearly $31 billion in infrastructure investment. That included financing 35,000 affordable housing units across 32 states. That's our 13th year as the country's #1 affordable housing lender. And in addition, we provide a variety of products to drive financial inclusion and work with CDFIs and MDIs to reach the underserved. As a proud participant of the OCC's Project REACH, we are co-leading the work stream that's focused on strengthening MDIs. And we are also engaged in initiatives to increase access to credit and reduce the number of Americans who are credit invisible. The strength of our financial system becomes most critical when the outlook for our economy weakens. Although we certainly don't see a drastic downturn on the horizon, history suggests that a recession is possible given the macroeconomic factors at play. And they include persistent inflation in services, rising debt, and a slowdown in global growth, as well as 2 major conflicts in Europe and the Middle East. And we're beginning to see some concerning signs in the lower FICO score segment of our customers. And this is unfortunately the very same group that feels any tightening of credit first. Raising capital requirements by as much as 20% on an industry that all participants believe is well capitalized is a bad idea in any environment. But it becomes even more problematic with economic uncertainty ahead. Almost every element of the Basel III endgame proposal would make lending and other financial activities more expensive, especially for smaller companies and consumers. The most likely result of increasing the cost of banks to offer a variety of products is that it would move more activity into the less regulated non-bank sector, which carries its own risk for consumers and the stability of the financial system. It would also diminish our industry's ability to compete internationally, especially with our European counterparts. I raise these concerns as I know we all share the same goal, that is of maintaining a strong and competitive banking system that supports a resilient economy. Thank you, and I look forward to answering your questions later today.
Thank you, Ms. Fraser. Mr. O'Hanley, welcome.
Chairman Brown, Ranking Member Scott, and members of the committee, good morning. I am proud to serve as State Street's chairman and CEO. To start, I want to be clear on what State Street is not. We are not a consumer bank, a commercial bank, a mortgage bank, or an investment bank. We do not serve individual customers directly, and we have no retail branches. What we are is highly focused on 2 lines of business: investment servicing and investment management. Our investment servicing business, which includes custody and related services, enables our clients to invest and execute transactions daily in markets across the globe in a safe and efficient manner. Our investment management division is a pioneer in indexing and quantitative investing, creator of many of the world's first ETFs and the world's 4th largest asset manager. Our low-cost, diversified investment products are the building blocks of savings and investments around the world. Both business lines have the same corporate purpose: to create better investment outcomes for the world's institutional investors and the people they serve. Our direct clients are institutions across the globe: pension funds, mutual funds, central banks, sovereign wealth funds, endowments, foundations, and insurance companies, holders of assets for the benefits of individuals, such as retirees, savers, or students. I would like to focus a bit today on my very strong view of the value and importance of custody banks. Quite simply, strong, effective custody combined with innovation in the asset management industry is the backbone of our democratized capital market, providing investors access in a secure and cost-effective manner to the investment products they need to meet retirement and other financial goals. The safekeeping custody banks provide ensures investor assets are held and accounted for where and how they should be. This has not always been the case. From the collapse of investment trusts in the 1930s, to the failure of the Studebaker Pension Fund in 1963, to the misappropriation of the Mirror Group Pension Fund prior to Robert Maxwell's death in 1991, to the Madoff scandal uncovered in the late aughts, investors are put at risk when there is no proper custody of assets. In contrast, proper custody regulation, such as the Investment Company Act of 1940 and ERISA, coupled with the enormous investments in technology by today's custody banks, has produced a modern time near perfect track record of safekeeping assets. The recent events around FTX, which did not use bank custodians, demonstrate that more remains to be done to protect investors' assets and the financial system. In the emerging digital finance space, a comprehensive, effective regulatory framework is not yet in place, and the consequences are clear. State Street is subject to the highest level of regulation and supervision. We are well capitalized, both stressed and unstressed. Our balance sheet is conservatively positioned to deliver liquidity when our clients need it. We are subject to extensive resolution and recovery plans. We are a proven source of stability for capital markets and our customers in times of stress. Despite the challenges of COVID and the banking stress earlier this year, the 8 GSIB banks before you have done their jobs exceedingly well, partnering with regulators during COVID and the SVB First Republic crises, and providing stability to our financial system. I am proud of State Street's strong performance over these stressful periods. Looking forward, the geopolitical environment is complex and unpredictable. The U.S. and the global economic recovery is uncertain as we all navigate higher interest rates and debt levels. And the financial services regulatory environment in the U.S. is in flux, in many cases with unclear goals. From a State Street perspective, I am concerned with the U.S. banking regulator's capital proposal, which I fear could negatively impact the U.S. economy by limiting bank credit extension and impairing the ability of U.S. banks like State Street to continue to provide high-quality custody and asset management services. I am also concerned by the SEC's proposed safekeeping rule, which, with no clear rationale, challenges some of the foundational elements of custody banking and, in effect, destroys the low-cost, near-perfect service now provided to investors. I hope these proposals can be adjusted, for if they not, they create risk of negative economic, market, and individual outcomes going forward. I am very proud of our company, our diverse workforce, and the role we play in the financial system. State Street and the other GSIB banks here are the most well-capitalized and technologically advanced financial services firms in the world. They are essential to America's competitiveness and prosperity. I look forward to our dialogue today.
Thank you, Mr. Hanley. Mr. Vance, welcome.
Good morning, Chair Brown, Ranking Member Scott, and members of the committee. I've had the honor of serving as the CEO of BNY Mellon for just over a year. I take this responsibility very seriously. As a company, we work for a strong, competitive banking system that serves customers and communities, supports the economy, and preserves U.S. economic leadership. My appreciation for this role has only grown as I get to know our history, our clients, our people, and our culture. Let me start with who we are. BNY Mellon is the nation's oldest bank, founded by Alexander Hamilton in 1784. Today, we are a global financial services company with 50,000 employees. Our client base is varied, ranging from governments and pension funds to corporations and financial firms. These clients all have different needs and roles in the economy, and we provide the services to put their money to work, keeping it safe, moving it, and managing it. While we're proud of our history and our leading market positions, we do not take them for granted. They are constant reminders to earn trust and to plan for the long term. We know that our economy will face challenges. It's not a matter of if, but when and for how long. It's critical that we are prepared to operate through these different conditions, being prepared to prevent, respond, and recover. This is what we mean by resiliency. It's a basic concept and a shared goal amongst our clients, regulators, and other stakeholders. And it's embedded in our strategy. One part of being prepared is financial resiliency, having enough capital and liquidity to weather unexpected market stress. We have a strong track record, and customers consistently look to us as a dependable provider during market disruptions. We aim to manage our balance sheet conservatively, with a high proportion of cash and high-quality liquid assets to adjust for changing market conditions. Another part of being prepared is operational resiliency, having the technology, the people, the processes in place to respond to events that could disrupt operations. I'm very proud of the hard work that our teams have put in to keep markets running smoothly, all through record volatility and volumes during the pandemic, wars, and market stresses. This work happens behind the scenes, and I want to commend our people who've made this happen. We have a long legacy of firsts as a company to solve problems and help move the country forward. We provided the first loan to the United States, and we were the first stock listed on the New York Stock Exchange. These actions, taken for granted today, were financial innovations at the time. But we cannot be complacent. Markets are uncertain. We must adapt to new needs and address new risks as we plan and prepare for the future. US leadership on technology, including on cyber, distributed ledger technology, and artificial intelligence, is important for our economy. This will require diligence and innovation by the public and private sectors to address them in a responsible way. Finally, I'd like to close with an emphasis on our more than 50,000 employees who do the hard work to keep our company and global markets running. Our goal at BNY Mellon is to drive a spirit of ownership, shared responsibility, and mutual success. Equity ownership in our company is an important part of this, and I'm particularly proud of our BK Shares program to grant equity to employees who otherwise would not have received stock. This program has benefited more than 45,000 employees and allowed many of them to become first-time participants in the capital markets that they help to serve. This is just one example of our culture and commitment to invest in our people and our company's long-term success. Thank you for your time, and I'm happy to answer any questions that you may have.
Thank you, Mr. Vince. Mr. Solomon, welcome.
Thank you, Chairman Brown, Ranking Member Scott, members of the committee. Thank you for giving me the opportunity to testify. I am proud to serve as the Chairman and CEO of Goldman Sachs and lead our incredibly talented team of 45,000 people around the world as they work tirelessly to serve our clients. Goldman Sachs has a deep history spanning over 150 years as a global leader in investment banking, securities, trading, and investment management. Our size, global reach, and capabilities allows us to provide tailored services and products aiding institutions, businesses of all size, and individuals in achieving their financial goals. We sit at the center of the U.S. capital markets, which forms the bedrock of our financial system and helps drive America's innovation. In fact, 75% of financing for U.S. businesses and state and local governments is conducted through our capital markets. A core component of our firm lies in the talent and expertise of our people and their commitment to advising our clients on buying and selling businesses, raising capital, and managing risks. In particular, Goldman Sachs serves as a crucial risk advisor to help businesses of all sizes navigate through challenges and financial risks that range from currency fluctuations and commodity price volatility to interest rate risks and various forms of credit risk. In addition, we finance infrastructure projects for local governments to invest in schools, hospitals, and roads. We also invest on behalf of our clients so that jobs can be created, retirement savings can grow, and economies can expand. We are able to facilitate all these activities because of the strength and resiliency of our balance sheet. In fact, since 2007, Goldman Sachs capital has nearly tripled, our liquidity has increased more than 5 times, and our leverage has decreased by half. In addition, the Federal Reserve stress tests have consistently confirmed that all of us here have sufficient capital to withstand a severe global recession. As an example, the scenario has included a 50% decline in equity prices within a year, in addition to separate global market shock that also features dramatic instantaneous declines in equity prices. You have the finest and most innovative financial institutions in the world represented here today, and we all served as a source of strength to the economy throughout the pandemic, the Ukraine war, and regional bank failures. Federal Reserve Chairman Powell, Treasury Secretary Yellen, and many other government officials of both political parties across 3 administrations have repeatedly stated that the largest banks are strong and well-capitalized. In the wake of significant interest rate hikes, I believe the U.S. economy has proven to be more resilient than expected, and the chances of a recession have decreased, although there are many reasons to remain vigilant. We are seeing a further tightening of financial conditions. The U.S. structural debt continues to grow and become more expensive to finance, and the geopolitical stresses associated with Ukraine, China, and the Middle East could impact economic growth and stability around the world. Against this backdrop, one headwind to U.S. economic recovery is the finalization of the new capital rules referred to as Basel III Endgame. These rules were conceived to create a common set of international capital standards without raising the aggregate amount of capital. However, the U.S. proposal does exactly the opposite. It's significantly more stringent than any other jurisdiction and would increase our capital requirements by about 25%. Although this increase in capital is the result of a number of overcalibrations throughout the proposal, I want to highlight just one of the many issues that is particularly punitive to capital markets activities. The proposal nearly doubles the capital for market-making activity. These higher requirements are simply layered on top of the global market shock that I discussed moments ago without any consideration for how they interact, resulting in a significant double count. As a result, banks will need to hold capital for many of the exact same risks associated with those market activities. As of the third quarter, the institutions most impacted by this proposal amount to 2/3 of both lending and capital markets activity in the U.S. In addition, since 2010, U.S. banks have underwritten 70% of equity financing and 60% of U.S. dollar debt financing. These punitive regulatory measures also run the risk of harming U.S. competitiveness and capital market strength globally, as well as pushing activity overseas and outside of the regulated banking sector without making the U.S. system far safer. Indeed, we believe the proposal will result in increased costs for airlines, manufacturers, food producers, pensions and mutual funds, insurance companies, small businesses, and energy companies. These costs will likely get passed on to consumers. For example, it would quadruple our capital requirements for clean energy tax equity products and would increase our capital 8 times for important transactions we enter into with pension funds to improve their returns for retirees. Systemic financial stability is critical to the functioning of the U.S. economy, and we should ensure that we are only taking actions that enhance the capacity of financial institutions to support our economy and provide demonstrable systemic benefit. Thank you. I'd be happy to take any questions.
Thank you, Mr. Gorman. Welcome.
Thank you, Chairman Brown, Ranking Member Scott, members of the committee. Thanks for having us here. I'm honoured to represent the Morgan Stanley employees today and for the last 14 years as their chairman and CEO. In 2021, we were still battling an extraordinary public health crisis. The economy was supported with monetary and fiscal stimulus and inflation was low. A lot has changed since. While inflation has receded from its highs, the macroeconomic environment continues to be very complex. We're also witnessing, as is obvious, substantial geopolitical challenges today. At Morgan Stanley and our institutional businesses, we help advise private companies and public sector entities for their financing needs. That includes raising equity and debt capital to fund and grow businesses, invest in public infrastructure, ultimately contributing to the growth of the economy. We assist pension funds, mutual funds, and other financial institutions trade and manage assets around the globe. In our wealth and asset management businesses, we're managing nearly $6.2 trillion of assets for individuals and households, as well as institutions like endowments and pension funds that manage the retirements of our public employees. For millions of US households, our services help families save money for retirement and for college and for a mortgage to build home ownership. The US banking system remains strong and is the envy of the world. It is an extraordinary asset for our country. Nowhere, not China, not Europe, not South America, not the UK,
not the rest of Asia, has a system remotely having these kinds of strengths. Large US banks have undergone a dramatic change in their capital and liquidity profile since the financial crisis of 15 years ago, when the US government, acted decisively and quickly in implementing the Dodd-Frank and CCAR reforms. As we saw earlier this year, there was a crisis among some regional banks. It was not a banking crisis. It was a crisis of 3 banks. It was in the spring, and it was quickly averted by prompt regulatory action. And with the strength and support from these large banks, we, along with 3 other banks, together provided $30 billion in uninsured deposits to First Republic to assist the regulators so that they could manage its ultimate resolution. It was gratifying, after being part of the problem in the 2008 financial crisis, to have the financial strength and stability to be part of the solution. Current proposals to put additional capital requirements, as you've heard today, on all the largest banks, the so-called Basel III endgame, need to consider the full impact of the US economy and what it will mean for US small business and consumers. Regulations are only effective when they find that balance. Blanket increases in capital for the large US banks who already undergo annual rigorous stress testing are required to maintain specific capital buffers already. Additional increases are wholly unnecessary. It will make credit more expensive, as everybody has said, make it less accessible for consumers and businesses, while harming the competitiveness of this economy, one of the great strengths of the US economy, the banking system. As it stands, the proposal would increase the cost of capital and borrowing across the economy, not just to large and small corporations, but to pensions, municipalities, and endowments. We hope the federal agencies will be open to the changes and reviewing the industry's comments thoughtfully. As a global leader in financial services, we have a responsibility to all the communities we operate. Many of those communities continue to experience social and financial challenges, and we're using our resources to help them. Finally, Mr. Chairman, your letter dated November 6, you asked me to provide additional information on a number of topics, and that's in the attached addendum. Thank you again, Chairman Brown, Ranking Member Scott, members of the committee. We look forward to your questions.
Thank you, Mr. Gorman. A productive third quarter for your banks. Your banks, as you like to say, returned capital to shareholders in the form of dividends and stock buybacks. During your earnings calls at the end of the third quarter, we heard statements about how you're going to continue to manage your businesses to deliver value to your shareholders. Of course, what we did not hear was any concern that your firms would not be able to meet the anticipated increased capital levels under Basel III endgame. If I'm mistaken, I would like you to set the record straight for the public and the investors. Do any of you have any reason to believe that your firm would not be able to achieve the increased capital requirements if Basel III was adopted as proposed? Any of you think you cannot you cannot achieve the increased capital requirements? Raise your hands if you think you can't. Thank you. I think you've indicated your firms will be able to meet the enhanced capital requirements. It leads me to conclude that the proposed capital standards are not too onerous. Mr. Scharf, American support for unions, as we've discussed, is at a half-century high. Unions help ensure that workers share in a company's success through better pay and better benefits, control over their schedules, greater stability to their personal and professional lives. Workers at 2 Wells Fargo branches will be voting to unionize this month. Dozens of other union organizing drives are in the works. Wells Fargo's recent scandals highlight the pressure that overworked and underpaid workers at short-staffed branches face. One worker said the executives don't have to deal with the consequences of their decisions in a direct sense, but we do. Mr. Scharf, I appreciate your willingness to talk one-on-one about this with me. I remain concerned about unfair labor practices and reports that Wells Fargo is geared up in response to the union campaign. Will you remain neutral as these employees vote to organize?
Chairman Brown, I agree with your sentiment about the importance of the workers and our employees. And as you know, we've done a tremendous amount to support them and will continue to do that. And we believe that it's best that we have a direct relationship with those employees, and we do intend to exercise our right to speak with them to make sure that they make an informed decision.
Thank you. It was an opportunity to show the American public truly a new day at Wells Fargo. I'm sorry that you failed to show that real change is afoot at your bank. Mr. Scharf, Mr. Moynihan, Mr. Dimon, and Ms. Fraser, according to the CFPB, failure to invoke the Service Members Civil Relief Act interest rate reductions cost service members $100 million between 2007 and 2018. You can unilaterally act to ensure service members receive those benefits, the escrow benefits they're entitled to. Do your banks proactively check authorized military databases to identify accounts that may be eligible for escrow protections? Begin, Mr. Scharf.
Chairman, we have huge respect for those that have been in the military. Specifically, to your question, I'm not sure, but certainly we'll check and get back to you.
Okay, thank you. Mr. Moynihan?
We again follow the SCRA provisions on an annual basis. We retroactively, looking back after we get notification, about $180 million a year we send back to those service members, including fees, which are not required to rebate, but we go ahead and rebate them. So I will check to make sure we're looking at all available means, but we comply with the law.
Thank you, Mr. Dimon.
I'm sure we comply with the law, but it's an opportunity to say that we've hired 18,000 veterans in the last couple of years. We support the United States military. We've hired 3,000 military spouses. So we stand 100% behind the class of citizens we hold in the highest regard.
Thank you. Ms. Fraser?
Similarly, with Chair Brown, we are very proud to employ many veterans, and we're incredibly grateful for everything that they do for our country. We make extensive investments in ensuring that we comply with the laws, and we do indeed tap into the database.
Thank you. Thank you for your candor about that. I urge you all to proactively check whether customers are eligible for escrow benefits. It's the type of work that you could be doing. The answers were helpful, and we will be back with all four of you about how we can help do that proactively. There's plenty we don't agree on. It's pretty clear. But I also want to finish somewhere we do agree. Supplemental security income. SSI provides a lifeline for 300,000 Ohioans, nearly 8 million Americans living with disabilities. The problem is SSI's eligibility rules haven't been updated by Congress. That's on us. In 40 years, they're now so outdated, they lock people in poverty. The Bipartisan Policy Center called SSI's asset limit the most regressive anti-savings provision in federal law. I have a bipartisan bill with Senator Rounds of this committee to raise the program's asset limit and stop punishing people for working and saving. Mr. Dimon, I know JPMorgan Chase is supportive of raising the asset level. I thank you for your leadership on this. Tell us briefly how it affects JPMorgan and why you're so supportive. Then I'd like to ask all of you if you would join Mr. Dimon and Senator Rounds and me in support. Mr. Dimon.
Senator, thank you. We have employees who don't want us to increase their salary because if it goes over a certain amount, they can't get that benefit, which they're entitled to. Or they can't have assets over $10,000. So this definitely should be fixed. We fully support it and try to be helpful if we can.
Thank you. Mr. Scharf, would you agree to support Mr. Dimon's position and mine?
It sounds like something that we'd be willing to support, but I'd like to take a look at it.
Okay. Mr. Moynihan? Ms. Fraser?
Fully and wholeheartedly.
Okay. Mr. Hanley?
We do support it.
Thank you, Mr. Vance.
We do support it.
Mr. Solomon?
We do support it.
Mr. Gorman?
Yes.
Thank you all. Senator Scott.
Thank you, Mr. Chairman. Question for the panel. The chairman asked a question about can you achieve the increased capital requirements? My question is, can you achieve the increased capital requirements without negative consequences to the economy and to lending?
Senator, we do have concerns that some of the items in the proposal will lead us to either increase the price or to reduce the amount that we lend.
There's a chart in the NPR that looks deceivingly simple. It says, here's the RWA before the proposal, and here's the RWA after proposal. It says 24% increase. That is a reduction in the capacity of this industry to serve its clients. No questions asked. The capital that could have been used to create those additional RWA incremental has to be used to sustain the same activities we have today with no risk from the day before to the day after and what the enterprise does. That's the point we're trying to make, is that this is about using our capital, whether we have it or not, and whether we have it to meet the new requirements to support additional activity, not the old activity, which doesn't help the American economy.
Thank you.
I think one of the frustrations you hear from this group up here is this question should have been asked before it went out. There's no question. We have to hold 30% more capital than international banks in the United States of America for every loan. A lot of loans have now fallen between, have become unprofitable. So a lot of loans, when we talk to people, they don't make sense for our company anymore. Small business, CDFI, solar, wind, middle market loans, certain trades you do with pension plans, et cetera. The work should have been done beforehand. By law, the QIS was the qualitative impact study should have been done beforehand. We had 10 years to do this, and it's shocking to me that we're sitting up there 10 years and we're talking about what's it going to do for small business, and we have to analyze it today. It shouldn't now. We all are going to fill hundreds of pages, thousands of pages of forms responding in a very detailed way to every single one of these things, but it was not thoughtfully done. I'm not sure it was shared fully among all the regulators. This should be relooked at.
And before I go to Ms. Fraser, my assumption is everyone's going to say, with consequences, that will be negative. So let me ask a different question to you, Ms. Fraser. The impact, and perhaps the unintended impact from Basel, the end game, on customers. We so often talk about the American consumer as if there's just one generic consumer out there. But from a state like South Carolina, where we have a lot of farmers, the impact on farmers and access to not only credit, but liquidity during the hard times. Can you perhaps give me a 30-second reaction to, will this have a negative impact on some of the rural communities that need derivatives? Will you walk me through that for a second?
Certainly, and thank you very much for your question, Senator. This will, to your point, increase the cost of borrowing for farmers and rural communities. It could impact them in terms of their mortgages. It could impact their credit card. It could also, importantly, impact their cost of any borrowing that they do. And let me give you an example. For a farmer, hedging your commodity costs and your commodity prices is an absolutely fundamental piece of providing stability and ability to sleep at night. Under the Basel III proposal, the cost of the derivatives would increase quite materially, and that would therefore have an impact on farmers' ability to do a fairly fundamental component of risk management. It could also impact their access to credit. So it's the cost of borrowing, it's the access to credit, and it's some of the fundamental tools that they need to manage their stability of their income.
Mr. Solomon, you said something earlier that I thought was really important, that as we discuss the Basel endgame proposal and its impact on lending and on folks like me that come from poverty or looking for the ability to achieve the American dream, someone would say, contrary to what I'm talking about, maybe there are other points that are important that I'm missing in my thought process, like, is it going to make our financial system safer? Have we not done enough work since the financial crisis of 2007 to 2009 to make sure that our financial institutions are able to meet obligations and responsibilities under an even worse case scenario? And your opening comments reflected that, yes, we can meet even a more disastrous crisis. Can you walk through the importance of the regulatory burden that exists and how the Basel endgame would make it even harder for small business lenders or small business borrowers, but not necessarily making our economy safer?
Sure. Thank you for the question, Senator. I tried to highlight in my opening comments, and Mr. Gorman highlighted it quite clearly. These stress tests are very, very significant tests that look at very, very severe shocks to our balance sheets. I highlighted a 50% decline in equity prices over a one-year period, on top of then a simultaneous equity market shock that has looked at much as 30% instantaneous equity decline. So very, very severe shocks that we've not seen even in the worst crisis. That puts buffers in place that protect the system. Now, of course, a sound and secure system is imperative for our capital markets, and we can always have debates at the margin as to whether or not there are things that we can do that can strengthen the system. But a wholesale increase of 25% capital on the largest banks with lots of individual provisions that affect different activities, I think is ultimately punitive to economic growth and doesn't strike the right cost-benefit analysis. We, of course, need to make the system secure. The system is in good shape. We've seen that under stress. That doesn't mean there aren't things that can be done at the margin. but this is a wholesale change that leads to problems. Ms. Fraser highlighted one example talking about farmers. You can look at airlines hedging jet fuel. If you want to look at other derivatives, which obviously gets passed on to consumers, you can look at gas being hedged in utilities, which obviously gets passed on to consumers. And then you can look at other transactions. There's a provision under the rule called SFT, which allows institutions like ours to borrow securities from pension plans and give them cash. That increases the returns. It allows them to use their assets to increase the returns. Capital would increase by 8 times for those types of transactions, which would make them unattractive and therefore would diminish the ability for pensions to access that tool to increase the returns.
Thank you.
Thank you, Senator Scott. Senator Reid from Rhode Island is recognized.
Thank you very much, Mr. Chairman. And first, let me all thank you for your support of our military men and women. They are superb, and their spouses are superb, so thank you for helping them out. With respect to the legislation that we passed several years ago, the Military Lending Act, I think the key aspect is the 36% interest cap. And I think it's such a critical aspect that it should not be just a province of military personnel, but every American. I think essentially your banks collectively have made about $219 billion in profit this year, and I believe that your credit cards are not beyond 30%. So the 30%, 6% rather, interest range seems to be very appropriate. And so I can go down starting with Mr. Scharf. Would you support a national 36% interest cap?
Senator, I appreciate your thoughts on this one. I think we would be concerned about setting a flat number without really understanding what the impact could be in different inflationary environments.
Mr. Moynihan?
Senator, it's not really relevant to us. We don't engage in prime lending. I think, as Mr. Scharf said, it's a question of balance. What would it push outside the system? What would it make not available? And I think, but it's just not a relevant question for us because we don't have rates that high.
Well, I guess in a general sense it's relevant because most of the people who use this adversely are payday lenders and rather dubious operators who will induce borrowers into arrangements which are something you wouldn't even tolerate. So I think that we've reached a point now after several years of questioning you all, and I'm not picking on you, Mr. Moynihan, to come to a conclusion. And I think the conclusion is it should. Mr. Dimon, please.
Yeah, we don't engage in that. I completely agree with your intent. I think there should be a focus on payday lenders and check cashers and certain things like that. And we'd love to help you design it so it accomplishes the intent without any bad consequences. There are some people who make very small loans who it may stop them from doing that and actually push people into payday lending.
Ms. Fraser, please.
Senator, thank you for the question. We applaud the intent of what you're trying to do. I think as large banks, we're very mindful of our responsibilities in protecting our customers from abuses. Experience has shown that caps diminish access to credit, can do in the systems, and the Federal Reserve has a study to show that. So I think similar to my colleagues, we believe there are other ways to achieve the intent, but we'd be supportive of following up with you on how.
Mr. O'Hanley.
Senator, we don't engage in consumer lending, but we do support what you're trying to achieve there.
Thank you, sir. Mr. Vince.
Senator, we're also not in the consumer business, but we support the intent.
Thank you. Mr. Sullivan.
We have a very, very small business in the consumer area, but we support the intent.
Thank you.
I support it, Senator. For normal, what I consider normal economic times, I actually came to this country and borrowed at 24%. So not quite your 36. I found that particularly heinous, but turned out okay. But no, I think anybody who's forced to borrow at 36%, that's sort of unforgivable.
I was living in the United States when I was borrowing at 24%. And in fact, I recall we had to repeal the Rhode Island legislation because it was 21%. So, again, I hope to work with you on this because I think it's very important. And I don't think it'll cause the disruptions which you might anticipate. I think it can be done. And I think the other thing it should be done, and I know many of you are doing it, is to go out aggressively and start getting people banked. One of the reasons that they find themselves borrowing money from unscrupulous characters is because they have not been fully introduced to the banking system, understand that it's relatively easy and it's much more appropriate than some of these other arrangements. But thank you all, and we'll continue to work, and any advice I'd appreciate. Thank you.
Thanks, Senator Reed. Senator Rounds of South Dakota is recognized.
Thank you, Mr. Chairman, and I appreciate the plug for our bill together. We do things occasionally on a bipartisan basis, even in the Banking Committee, but we also have an opportunity once in a while to disagree, and sometimes that means that we get to have you folks participate in that disagreement process. Today, you're going to hear us talk a lot about consumers, as they are the latest victim of heavy-handed Washington bureaucrats. In the last few months alone, financial regulators have put forth or finalized regulations and guidance that represent the biggest rewrite of banking regulation since the passage of Dodd-Frank. We've seen regulations on bank capital, long-term debt, resolution planning, the Community Reinvestment Act, and climate risk management, just to name a few. However, we know that none of these regulations exist in a vacuum. Vice Chair Barr said himself that the Basel III endgame proposal is, and I quote, projected to raise capital for large banks. This may result in higher funding costs. But this is only half the story, end of quote. I want you to help tell the other half of the story. Now, I was just gonna ask this of one of you, but since our chairman has kind of set the example of asking folks to raise their hands, and I'm going to apologize in advance because I think folks hate to be put in that position, I think it's critical that you get to tell the other half of that story. None of you raised your hands when you said that it would be, that it was a case of where you couldn't meet the capital requirements. The issue is what damage it does to the economy when you're expected to raise that and the folks who need that capital. So here's my questions, and I'm going to ask you to raise your hands. I apologize for that. But if you agree with these assessments, would you please raise your hands? Do you believe in its current form, could these regulations negatively impact first-time home buyers? Do you believe in its current form, could these regulations negatively impact those saving for retirement? Do you believe that these regulations could negatively impact our farmers and our ranchers? And do you believe that these regulations could negatively impact small business owners? See, this is the rest of the story. Sometimes we think that we're just beating up on the big banks, but the bottom line is it hits the American consumer where it hurts. This is at a time that when they try to go after the big guys, it's the American consumer that will suffer. You can already see the signs of consumers struggling as they are utilizing the buy now, pay later approach to products and making late payments on credit cards. This is because Americans are paying more per month just to get by since President Biden took office. Bidenomics has led to a family of 4 in South Dakota needing to pay over $900 more in month just to get by for normal living expenses. I'm going to say this again, regulation does not exist in a vacuum, and the Federal Reserve must take this into account as they work towards finalizing their rulemaking. I won't embarrass you by asking you to raise your hands anymore. I apologize for that, but I think it's important that the American people see the rest of the story and who is really going to pay the bill for this overzealous approach, and without finding out the rest of the story about these types of regulations and who really gets stuck with it. In recent years, U.S. federal debt levels have climbed further, and annual interest on the debt is slated to reach over $1.4 trillion in the next decade, almost outnumbering all discretionary spending. I'm concerned about what risk rising indebtedness poses to the economy. According to recent estimates by your institutions, the Treasury will conservatively need to issue $20 trillion of debt in the coming decade. I'm not only concerned about who is going to buy this massive issuance of treasuries, but with a federal funds rate of 5%, the federal government is going to be paying even more to borrow as treasuries with near zero rates mature. Mr. Solomon, how could sustained high levels of debt have adverse effects on the U.S. Treasuries market, the dollar, and the general economy?
Thank you for the question, Senator. This is a significant issue and one I tried to highlight in my opening remarks. The growth in the U.S. Treasury debt has been very, very significant over the last 15 years. It's more than tripled. That debt will continue to grow as the cost of refinancing that debt will also grow. The Office of Budget and Management, looking out through the decade, estimates a 3.5% cost to refinance the debt, but I certainly think there are scenarios where that cost could be higher. This cost obviously hampers our ability to invest in other things, as a nation that we need. There certainly is a lot of attention and focus on things that are needed to strengthen our economy, to strengthen our society, and the cost and that burden of the debt to future generations based on decisions we've made is something that we're going to have to get focused on. As the cost of debt goes up, it certainly can create volatility in our funding treasuries. It can create volatility in the treasury market. One of the things I'm also concerned about when I look at Basel III Endgame is one of the impacts is to a business called Prime. The business of Prime finances institutions' securities positions. So asset managers, investment managers, asset management platforms that regularly trade in the Treasury market provide liquidity to the Treasury market. And the cost of the financing that they have to finance those positions would go up with this proposal, and it could potentially, therefore, impact liquidity. And so that's another risk that I think we need to look at carefully.
Thank you, Mr. Solomon.
Thank you.
Thank you, Mr. Chairman.
Senator Tester is recognized from Montana.
Yeah, I want to thank the chairman and ranking member for holding this hearing. I want to thank the panelists for your testimony and for being here today. And I also want to echo Senator Reed's comments on your support for the military, both active duty and veterans. Them and their families is very, very important. I serve as the chair of the Defense Appropriations Committee. I spend a fair amount of my time thinking about national security, how to protect against folks who want to do this nation harm, terrorist organizations, as well as foreign adversaries. You all have responsibilities, including legal responsibilities, to make sure that you're preventing hostile governments like Iran that would like to see the U.S. not exist from financing terrorist operations and other illegal activities with funds that have gone through your institutions. So this would be a question for Mr. Gorman, and then not for any particular reason, it's just he's right in front of me. And then if any of you would like to add, you can. So the question is, how are you as chief executives making sure that procedures are in place and that they're followed so that your institutions do not end up inadvertently financing illicit activity?
Senator, thank you for the question. Obviously, it's critical as a good player in this country to do our best to work with the government. There are two things that I just point out. The first is what I call our cybersecurity efforts to understand incoming into the financial system. Several years ago when I started this job, I believe we were spending about $50 million on that activity. The number is closer to $1 billion now. We work very closely with all the intelligence agencies, ensuring that we have a proper cyber command to keep the financial system safe. And then secondly, as it relates to specific individuals, bad actors, governments, we have an enormous compliance effort focused on anti-money laundering to ensure that they don't get in by verifying the source of where their funds come from. Obviously, we deal with not as many clients as some of the institutions here, but we still have over 18 million individual clients and many, many tens of thousands of institutional clients. So it's an extraordinary effort with several hundred employees constantly working. Interestingly, I think the advances in AI will be a real strategic weapon in this regard.
Very good. Anybody have anything different to add? All right, thank you. Along those same lines on anti-money laundering protections and national security safeguards, Mr. Gorman talked about cybersecurity. Mr. Solomon, would you like to add anything in regards to anti-money laundering protections that you have?
I don't have anything to add that's materially different from what Mr. Gorman stated. An enormous focus. We file thousands of SARs in the course of our compliance department's financial crime team, working every day, but no difference in that focus and the intensity of that focus.
Very good. Earlier this year, Mr. Scharf, Wells paid nearly $100 million in penalties to the Fed and OFAC for violating sanctions against Iran, Syria, Sudan. I think we can all agree that's not a good thing. But what is your bank doing to make sure that these sanction violations never happen again?
Sure, Senator. Preventing bad actors from abusing our services is a top priority. We have extensive systems in place that we're constantly looking to make sure that they're as complete as they possibly be. We work in industry groups, we work with the government, and we work with the regulators to make sure that we're doing everything we possibly can to prevent that abuse.
Thank you. This goes to the non-banking world. Some of you have talked about the fact that, and maybe all of you have talked about the fact that this will force, Basel will force money to go outside the traditional banking system into the unregulated banking system. Ms. Fraser, could you just talk about what kind of impact that you see that having from a, I don't know if you can project a percentage of money that you would see going into the non-banking system, but it would be interesting because I remember in '08 that was the problem, one of the problems.
Yes, Senator, we are worried about the migration of financial activities into the non-banking sector, particularly in a period where there is tremendous technological innovation, and making sure that we maintain the safeguards that we all invest billions of dollars in a year, be it anti-money laundering, be it fraud protection, be it cyber protection. All of these areas protect the American consumer, protect the American saver, safeguard the system, and also the critical role that all of our banks play in the global financial system as a strategic asset of the U.S. Okay. So we are very concerned that this will undermine some of the strength and foundations of the unique American financial system.
Thank you all. Thank you, Mr. Chairman.
Thank you, Senator Tester. Senator Tillis of North Carolina.
Thank you, Mr. Chairman. Thank you all for being here and for the preparation. I'm actually very pleased. I thought it was going to be the annual flogging of the GSIBs, but people are asking very serious questions. I'm glad to hear it. I've got a few serious questions for you all. Number one, I want to start by saying that thank goodness you're not the head of a thank goodness you're not the head of an organization that's had an expose on a culture of sexual harassment and workplace hostility, because I guess if you were, every person up here would be asking for your resignation, including me. But we've got a top financial regulator that gets a pass. I don't expect you to respond to that, but it's true. That same financial regulator has implemented an SEC cyber reporting rule that now we have evidence that the ransomware companies are exploiting, right? Okay, this is a mandatory cyber reporting requirement that now a ransomware company has gone on record as reporting. I don't even want y'all to respond to that, but we've got, detailed questions, we're going to ask you what impact this is. A 4-day reporting requirement, a national security waiver that you have to reapply for every 30 days, and it has to be approved by the Attorney General. These people are out of control. We've got to try and repeal this one. I'm actually putting forth my first CRA to try and do that next week. Hopefully, the SEC can see that the bad guys are exploiting a rule, creating a burden for our financial services industry, and not producing a good result. That's all on that. I want to go back to the operational risk question. And I think that Senator Rounds did a good job of saying this Basel III endgame is bad. It's not very well thought out, and hopefully it's going to look very differently before it gets promulgated. But who would like to speak for this group around the impact on operational risk just one more time and how we think that they've missed it in terms of the benefit? Mr. Gorman, if you could do it in 30 seconds, I would appreciate it.
It makes no sense. I mean, that's the bottom line. I've been at this for a long time. I served on the New York Fed board for years. I've seen a lot of rules. Some of them make sense, and it's a question of how far you turn the dial. This doesn't make sense. You shouldn't punish institutions for creating fee-based businesses.
Is there any evidence that that work has been done to really understand the fully burdened cost and the impact of this rule on the industry? And more importantly, people like my dad who would get 90-day notes to fund his construction job that I used to work on. Is there anything out there that I've missed in terms of the regulators actually doing an exhaustive study of the impact and the downstream implications? Are you aware of anything that I have just simply not read?
I'm not aware.
Okay, thank you. Mr. Solomon, would you go back to I think you mentioned SFT, Security Financial Transactions. Can you go back and talk a little bit about why people in the pension business should be worried about the promulgation of this rule in about 30 seconds?
Sure. Securities financing transactions are transactions where institutions like ours borrow stock securities from pensions. We pay them cash. They can then invest that cash and earn returns. The capital in Basel III attributed to those transactions goes up by 8 times, would make the transactions uneconomical for businesses like us, so we would exit that business. That would then prevent the pensions from having that ability to increase their returns through that activity.
So anybody who is sitting on top of any sort of pension management should understand that if we implement it in its current form, their returns, at least in this segment, are likely to go down.
They are an end user that would be impacted.
Yeah, okay. Let's talk more about just I want to talk, I actually have to get something off my chest because I've heard more, I'm kind of doing that, y'all may have noticed, but I understand that you are gaming CCAR, that somehow that you can game stress testing. That's what I'm hearing from regulators. I'm hearing from my colleagues on the other side of the aisle. Give me an idea of how you game the system. I actually thought that this is a regimen that's provided by a supervisor or an examiner, and you've got to execute it, and then they have to measure it. Is that how it works? Any of you here want to share with me how you game the system? I used to work at Price Waterhouse. We didn't have a practice on gaming CCAR or stress testing at the time. Have y'all cracked that code? How many of y'all think it's absurd to think that people would actually assert that you could game a stress test? Okay. How many of you think that you're spending more time and money on trying to satisfy stress test requirements at the expense of looking at real risks that are unique to your banking activities?
I'll take this one.
Okay, Jamie.
The CCAR test is 200,000 pages long. Most of us do 10, 20, 30, 40, 50 tests a week. We're quite worried about risk. It's one test. It's to the nth degree. It's a big black box. So we all agree in stress testing, that thing's just out of control.
Yeah, and you know, in closing, look, Silicon Valley was a disaster. It was a fingerprint. It was unique in terms of their activities. It was a failure of supervision, in my opinion. And one thing I hope that we have over the next year is a hearing on everybody who was in the loop, who failed to protect the investors and the depositors at Silicon Valley. Thank you, Mr. Chair.
Thank you, Senator Schultz. Senator Menendez of New Jersey is recognized.
Thank you, Mr. Chairman. For over a decade, the CFPB has stood up for everyday Americans and fought back against abusive and unlawful practices by large businesses, including some of the banks in this room. Mr. Dimon, how much money has JPMorgan Chase returned to customers in the form of redresses and payments at the direction of CFPB?
I don't know the number.
Let me help you. $360 million. Mr. Moynihan, same question.
I don't know the number specifically.
$819 million. Ms. Fraser?
I don't know the number either, Senator.
$1 billion. Mr. Scharf?
I don't know the number, Senator.
Well, it's over $2 billion. So from just the four of you, that's over $4 billion. It's amazing you don't know the number because they're not small in nature. Over $4 billion returned to hardworking consumers in the past dozen years. And yet this critical agency is under constant attack by my Republican colleagues. A lawsuit before the Supreme Court is threatening its very existence. And time again, we've seen why the CFPB is so necessary and why I intend to continue to fight for it. Otherwise, that would have been $4 billion out of the pockets of U.S. consumers. Now, while some banks have either decreased or eliminated overdraft fees altogether, in large part due to increased scrutiny and oversight, banks still collected an estimated $7.7 billion in 2022 in overdraft and non-sufficient fund fees. Ms. Fraser, your bank eliminated overdraft fees last year, isn't that correct?
Yes, Senator.
Is it fair to say that Citi is still a profitable bank?
Yes, Senator.
Did overdraft fees upend your business model?
No, Senator, we work hard to protect our customers and make sure that they don't fall into overdraft.
Now, the rest of the banks here that have retail operations continue, to my knowledge, to charge overdraft fees. Mr. Moynihan, Mr. Scharf, Mr. Dimon, you're all aware that Black and Hispanic households disproportionately incur overdraft and NSF fees, correct? Do you know that? Yes or no? Okay, could you give me a verbal answer, please?
I believe so.
If that's your statistic, I don't have any reason to challenge it.
Same for me.
Well, the reality is that, again, it's amazing you don't know that. Study after study have shown that the answer is yes to that question. So I suggest you call Ms. Fraser after this hearing to figure out how you can still be able to eliminate the fees in its entirety and still run a profitable bank. Charging the fees is a choice, one that disproportionately harms Black and brown communities, and it's something that you could do that would change the course of events for a significant part of the consumer base. The lawsuit currently before the Supreme Court over the CFPB's funding structure has the potential to upend every rule, guidance, and order the CFPB has ever issued, tossing over a decade of consumer protection law out of the window. That's not just harmful for consumers, I think it's dangerous to the financial system. The CFPB doesn't just issue regulations, they also provide safe harbor provisions like the qualified mortgage rule, which protects mortgage lenders from certain lawsuits. Mr. Scharf, Mr. Moynihan, Mr. Dimon, Ms. Fraser, if you were to lose this safe harbor, would it impact your bank's mortgage lending?
I don't think it would make a difference. We did mortgage lending before this, we do it afterwards.
I think it completely depends on the actual detail in the ruling.
Sam, I'd like to know the specifics to draw a conclusion.
Same as my colleagues, I'd need to understand the specifics more.
Well, I'm saying if it would just if you would lose it, not if it's limited or what. If you would lose it totally, it seems to me pretty remarkable, based on previous testimony of how important the safe harbor provisions would be to banks' mortgage lending abilities, that you would suggest that it would have no effect whatsoever. We're already in the midst of an affordable housing crisis, and eliminating the CFPB and such a rule would have a disastrous impact on the mortgage market and make it harder for families to buy a home. Finally, the number of physical bank branches in the U.S. have been trending downward for some time. This has left more and more residents in so-called banking deserts, facing difficulties in carrying out basic financial tasks such as paying bills and depositing checks. A Philadelphia Reserve report found that bank closures during the pandemic resulted in the number of banking deserts in the 3rd District states of New Jersey, Pennsylvania, and Delaware rising from 48 to 63. Now, I understand part of this is mobile and online banking, but there are many who do not have the abilities to do that. What are some ways that we can ensure communities continue to have access to basic banking services?
Two things, Senator. I think if you look at the people who have big branch systems, we maintain approximately 30% of our branches. Mr. Scharf said earlier, was same for us in LMI neighborhoods. But importantly, one of the things that's gone on, and you mentioned, is we're up to 97% of our LMI customers use digital banking, which then is more convenient, more safe, and reaches them where they are. And so we manage that carefully to make sure we cover every market and make the calculations. You can see that in the published statistics. But if you look at what we do as a group of institutions, we maintain that presence, but we've driven the digital, and we've driven the types of accounts that are more appreciated. And that's why we're bringing 2 million people into the banking system that were unbanked a few years ago. It's largely these larger banks that have driven that.
Well, I'd close by simply saying I would commend to all of you that you look at how your practices affect particularly minority communities, including on this issue. You have a disproportionate effect, and there's something you can do about the largest growing parts of the American society that would be beneficial to you and beneficial to them. Thank you, Mr. Chairman.
Thanks, Senator Menendez. Senator Kennedy of Louisiana is recognized.
unlike some, I do not think you are crooks. In fact, you're all American companies, and I'm proud of you. And I thank you for supporting the most sophisticated and powerful economy in all of human history, and the jobs you create for Americans in doing it. Mr. Dimon, since the last time the federal government raised your bank's capital requirements in Dodd-Frank and otherwise, have you had a depositor run on your bank?
We have not.
Have you failed a stress test?
We have never failed a stress test, no.
Have you ever reached a point where your liabilities were greater than your assets?
Absolutely not.
Well, unfortunately, we've had 3 banks this year that did go broke.
Mm-hmm.
They're mid-sized banks. You know them, Signature, Silicon Valley, First Republic. We've held hearings. In my judgment, they went broke because their management did really stupid stuff. And because the FDIC and the regulators who were in charge of keeping them from doing stupid stuff sat there like bumps on a log, sucking on their teeth, and watched them do stupid stuff. And in many cases, had to turn to you to clean up the mess. Now, in fairness to the FDIC, it may have been that the people in charge of watching those banks at the FDIC were too busy urinating off the top of a hotel or abusing young women who went to work for the FDIC. The FDIC chairman told us recently, yes, he knew about it, it happened, but he wasn't the chairman yet and didn't have the authority to stop it. Mr. Dimon, don't you find it ironic? The FDIC is now turning to you and saying, you know our track record, which is blemished at the FDIC. Your bank isn't broken, but we're going to tell you how to fix it. Do you find that ironic? They're going to tell you how to fix it based on standards put together by bureaucrats in Basel, Switzerland, not by the United States Congress. Mm-hmm. Do you find it ironic that they're telling you this and proposing this? Isn't that kind of like being given gun safety advice by Alec Baldwin?
Mm-hmm. Should I answer the question? So the major risk of those banks was hiding in plain sight, which is interest rate exposure. That was known to most people who actually could read a balance sheet and read their financial statements, and that's true. I also think
the FDIC said they didn't know. They were busy doing whatever else they were doing at the at their Gomorrah of carnal abuse over there.
Yeah. I also do think you're making a good point that some of these rules were put in place, and some folks have mentioned here, are pushing business outside of the banking system. And to point out exactly what that is, it's almost 80% of the mortgage business today. It's half of the leveraged lending business today. And it's a bunch of other things which people don't actually see about the plumbing of the system. And I do think it's adding risks about transparency, and a very important thing about the impact.
Let me stop you, Mr. Dimon, because I'm going to run out of time. How is this even legal under West Virginia v. EPA? You have bank regulators without clear direction from Congress who are borrowing standards from other regulators in Basel, Switzerland, imposing them on you without clear directive from Congress. It clearly falls under the major questions doctrine. Why doesn't this violate West Virginia versus EPA? You don't have to know a law book from an LL Bean catalog to see that. Why doesn't it violate the law? Anybody.
Senator Kennedy's time has expired. Senator Warren from
Well, Ms.
Virginia.
Fraser was about to answer.
Would you like to answer, Ms. Fraser? I thought you gave her time. Proceed, please.
I think we very much appreciate your points of view, Senator, on this topic, and I think many of us would concur. While violations of law, we hope, are things that we will debate as a last resort. We would be prepared to do so because it's important that there's clarity in the law and that we abide by it.
Thank you, Mr.
Senator Warner.
Thank you, Mr. Chairman. I do find it's kind of an interesting presentation, the yin and yang of whether you're the source of all challenges or the regulators are the source of all challenges. Somehow I don't believe either presentation represents the truth. And my questions on Basel III have been raised already. I've indicated I think the timing at this moment is very problematic with interest rates as high as they are, and obviously members of the civil rights community have raised this as well. But before anybody smiles too much, I can also tell you that I get extraordinarily frustrated that any time there is any proposed new regulation or rule, the normal industry reaction is, oh my God, the sky is falling. And the same response is always, you do this, it's going to limit access to capital on Main Street. And I actually do think Senator Menendez's presentation, particularly on CFPB in terms of dollars returned, was pretty good. But I want to actually go to an issue that I've raised with many of you in the past, which is I do believe before we add new regulatory tools about the safety and soundness of our system, one of the things we actually ought to use better is some of our existing tools. At the very beginning, when the Fed was stood up, the most important liquidity tool was the discount window and use of that tool. And yet we saw with the banks that failed this year, particularly in terms of SVB and Signature, they didn't even have procedures in place to know how to utilize that tool. So I think I'll start with Mr. Moynihan on this one. But I know there was guidance given out this past July to say everybody ought to get their act together. And candidly, I don't have a lot of sympathy because of the concern that many of you and other colleagues have raised that, oh my gosh, if I go to the discount window, that's going to raise a stigma with the market. Well, you can't complain about new regulations if you aren't using existing tools. So beyond the guidance that was given, why shouldn't we have, maybe on some kind of random basis, a mandatory use of the discount window so that we could start erasing that stigma to make sure that every bank, from large to small, know how to use it, because at least in terms of liquidity, this would be the most powerful tool of all. Mr. Moynihan.
So, Senator, I think two things. One, readiness to use it, and I think you'd find that the institutions all here, because of the amount of regulation we have, are ready to use it, and that was an issue of readiness that you rose. But then the second question is the stigma, and we couldn't agree more. Whether it was in 7 and 8, whether it was in 2020, or whether it was last spring, every time a crisis hits, one of the core roles of the reason why the Federal Reserve exists is to provide that liquidity at a time of stress and lender last resort. And every time we're 100% reluctant to use it as an industry because it looks like we're weak, and we've got to figure out a way to change
somehow,
it.
Again, and that's again where I think you see folks on my side of the aisle complain that, you know, if you're not using existing tools, well, maybe you ought to look at new tools. And I would love to engage with you. I'm going to put legislation forward that would require some mandatory usage, and maybe, again, how we do that on an episodic basis. But just saying we know there's a stigma problem, but we don't have a plan to address it, means that somebody that might be sometimes sympathetic to you, if we can't use that tool, my sympathy is going to go down dramatically.
We agree with you, Senator.
Let me try to hit a couple of other types. Artificial intelligence, I know, has been touched. I personally am surprised that there is not greater concern about AI in terms of using its ability to disrupt faith in the public markets. To me, it feels like if there was ever a time and a tool that has such wide-reaching implications, that FSOC, which I know his record has been somewhat mixed, but I strongly believe FSOC ought to take on the responsibility around looking at artificial intelligence in terms of safety and soundness to the overall system. Ms. Fraser, we've talked about this a little bit. What do you think on that issue?
Thank you, Senator. You're raising a very important issue and topic that has all of our attention at the moment. When we look at artificial intelligence, it's both an opportunity and a threat. On balance, we all hope it will be an opportunity to improve the strength of the financial system and of human beings, but the threats are also quite considerable. We have a lot of regulation that is in place right now that works very well to safeguard our financial system. We think that regulation should continue to be used to guide
Let me
the
just say,
system.
I know my time's up, but I do think FSOC is a tool, and I would make the case, and as others have made the case about underserved communities. Some of you are participating in the Economic Opportunity Coalition and some of our efforts with CDFIs. That is still a tool to get into LMI communities. Those of you who are not participating, this is bipartisan, led by Deputy Secretary Ariamo out of the administration. I hope you'll consider it. Thank you, Mr. Chase.
I'll yield some of my time to him, Senator.
You have no time to yield. Senator Haggerty of Tennessee.
I tried, Warner.
Thank you, Mr. Chairman. And to all of you, welcome. I know how much you must look forward to these meetings that we have here. But today, my colleagues have focused a great deal on the Basel III endgame. It's something I'm deeply concerned about, too. What we have here in Washington, regretfully, are regulators that are in a competition with bureaucrats and other jurisdictions. They seem to be regulating for regulation's sake. I have a very difficult time when massive bodies of regulation are put forward and bureaucrats here try to tell us that the impact is going to be minimal. I'd like to quote specifically from Vice Chair Michael Barr, who's leading the effort on the Basel III endgame. He says that the impacts of the new requirements they're proposing are going to be minimal. In fact, specifically, he says, quote, "The phase-in will allow ample time for banks to adjust their balance sheets and activities and to build capital over time. In fact, most banks already have enough capital today to meet the new requirements." So the message that the public is getting is that these massive regulatory proposals they're putting forward with Basel III is going to have a very minimal impact on your banks. And I would just like to go back to the tool everybody else is using. Would anybody here that believes that the impact of Basel III would be minimal, raise your hand, please. I'd like the record to reflect, Mr. Chairman, that nobody raised their hand. No one believes that the impact will be minimal. In fact, I think one of the most infuriating patterns of behavior I see here among the regulatory class in Washington is either an unwillingness or a refusal to take into account the knock-on effects of the regulations. Mr. Dimon, I'd like to come to you. Your bank has stated publicly that the Basel endgame proposals would increase capital requirements by some $50 billion. That's not an insignificant number. There are obviously very real costs that are associated with this proposal, and I would like to get your perspective on how this proposal would impact not only your bank, but the markets and the economy more broadly.
I think, inside a bank, you try to look at every loan you make and every relationship and every client and every country, and obviously you want to do a good job for your shareholders in the long run. No one tries to be rapacious with customers or employees in the short run. And that, would it take a lot of loans and immediately make them unprofitable? And I'll give you a specific example, mortgages. I've already told our people that mortgages should not be in the balance sheet. And of course, we can't securitize them either because we haven't passed the securitization law, so it will diminish certain kind of mortgages. It'll particularly diminish mortgages for lower income people. And because the cost of all this is actually much higher on a $150,000 mortgage than on a jumbo $2 million mortgage. And I can go down the line, CDFIs, financial companies, farmers, and then we've already mentioned the extreme effect on market making, which is just a critical function to help finance companies around the world and help people manage money for retirees and veterans and state pension plans to manage their money. And so that one is hard to figure out the full extent of that. I think it actually may cause issues in the marketplace.
All these knock-on effects, I think, are very negative. Ms. Fraser, not limited to your bank in particular, but just if you could comment on how this impacts the U.S. banking system's competitiveness on an international basis.
This diminishes the U.S. Banks' competitiveness on an international basis. I think, as we've all reflected, The US financial system is the envy of the world. The US banks play an incredibly important role supporting multinationals and supporting the Western financial system and its operations. It's a strategic asset of the US.
Indeed, indeed, and I think it's incredible and competitive advantage. Yet the regulators that are focusing on Basel III seem to be hiding behind the claim that this is merely a harmonization of capital requirements. And when you think about a harmonization of capital requirements, it would lead you to believe that U.S. banking capital is somehow below that of our European competitors. And if that were the case, this might allow regulators to prevent, quote, a race to the bottom. But this is not the case. I want to quote from Chairman Powell. Chairman Powell says, quote, "The proposal exceeds what is required by the Basel Agreement, and it exceeds what's been required and what's been done through implementation by other jurisdictions." So, Mr. Solomon, I'd like to come to you. You made reference in your testimony about the competitive disadvantage that this unnecessarily stringent proposal would create for financial institutions, for the economy more broadly. And would you mind to just comment on how this proposal, if it were enacted, would compare us to other jurisdictions you're dealing around the world, but how it would make our competitiveness be affected in capital markets specifically versus other nations?
Thank you for the question, Senator. As you stated, the capital requirements in the Basel III normalization in the UK, in Europe, in Japan, and in other jurisdictions are meaningfully less significant than what's being proposed here. And so if you look at activities that we compete in around the world, particularly in market making and those types of activities, the U.S. capital markets are the strongest capital markets in the world. I think it's one of our big competitive advantages that everyone comes from all over the world into our capital markets. If you think about IPO activity and debt capital raising, it's done to a great proportion for international capital in our capital markets on a relative basis. And this would just shift that balance. It would push more activity into other jurisdictions. It would make banks in other jurisdictions more competitive. And I don't think that strengthens the U.S. position over time.
And conversely, American banking system less competitive as well.
Thank you.
Thank you very much, Mr. Chairman.
Senator Cortez Masto of Nevada is recognized.
Thank you. Thank you, Mr. Chairman. Thank you all for being here. I know the last time you were here, we talked about affordable housing. I want to continue the conversation. As we know, not just Nevadans, but so many people across the country are struggling to afford homes. One way to do that, I believe, is by investing more in affordable housing through the Federal Home Loan Bank system. As we all know, the federal home loan banks enjoy federal benefits that really no other bank has access to in exchange for supporting affordable housing and community development across the United States. Last month, the Federal Housing Finance Agency published 2 reports, I called for them, exploring whether the Federal Home Loan Bank's hundreds of billions of taxpayer-supported dollars are being well used for affordable housing and community development. The answer, according to this report, was no. Federal home loan banks currently only provide about 10% of their net income to affordable housing. I, again, believe that's too low. My question to all of you is, do you think the Federal Home Loan Bank should provide 20% or more of their net revenue for affordable housing or economic development? And does anyone not support greater affordable housing investments by the Federal Home Loan Banks? So let me ask you this. Let me just, for the record, nobody has said they don't think there should be more investment. So you think there should. Is 20% enough? Is 20% more? What more should we be looking at?
Properly done, 20% would be fine.
Does everybody agree with that? 20% would be fine? Does anybody not agree with that? Good. All right. Good start. And I'm trying to do this so you don't have to raise your hands. I don't like that either. I think that's kind of ridiculous. Let me say this. The Federal Housing Finance Agency is proposing to adjust dividends and advance rates to better reflect the bank's support of affordable housing and community development. Does anyone not support having the Federal Home Loan Bank's dividends and advances tied to missions activities of financial institutions? Is that a good start for us as we are looking at this? Does anybody have any comments regarding that and concerns? So it is a good start from what I see the nods of all of your heads. Great. Next question. FHFA has recommended that 10% of all institutions' assets be held in housing assets. 96% of credit unions would meet that test, but likely not some of our biggest banks. Under the proposed new policy, would any of your institutions invest more in housing to retain access to Federal Home Loan Bank funding? Questions, thoughts? Ever thought about it? Still need to think about it?
I think many of us meet it today, but I think, Senator, that the trick is, going to Mr. Dimon's last point, is if some of these rules change, we'll have to shrink our mortgages on balance sheet, which would make us less eligible and less able to live up to the principles you're doing, which is how much housing can we help drive. And so I think with everything balanced, but a lot of us meet that test today because of our business constitution.
So the concern is if the new changes in the rules might have a negative impact on what we're trying to achieve here at the end of the day.
Yeah,
Is that what I'm
mortgage
hearing?
loans are tricky to hold. And if you make them more capital intensive, they're going to be less profitable, and if we're going to hold less of them, and already 80% of the activity goes on outside the financial institutions today. And so I think these rules may frustrate your intentions of what you're trying to do with the Federal Home Bank boards. And so we applaud that. We think more affordable housing, but you might be frustrated on the other side. So I think that's the kind of thing we worry about.
Helpful, thank you. I'm going to jump to one other item around affordable housing. Currently in Southern Nevada in Clark County, which is the most populated part of our state, Clark County is looking at new ways, innovative ways to build more affordable housing. One of those is really looking at land trusts, federal land trusts. And the challenge they're having is they're not able to get any of the banks to write up the loans or the mortgages for these land trusts. And here's what I know. For decades, and this is what I want to talk to you about, for decades, banks have invested in apartment buildings that are deed restricted to require affordable rents. But in Clark County, so far, not a single bank has been willing to meet Clark County to discuss providing mortgages for deed-restricted standalone homes on federal land. That's the key here, is the federal land. I've worked hard to make sure more federal land is available for housing. It's frustrating to see that, unfortunately, the banks refuse to offer mortgages to new homes on federal land. The Clark County Land Trust has been looking for mortgages for 240 permanently affordable homes since August. Clark County has 2.3 million people. It's the top 30 largest metro area in the country. The county has a AA+ credit rating. So I guess my question is, what are we missing here from all of you that we need to be aware of why we can't get a bank to come work with us on these land trusts?
I would love to get a team working the detail of that, because I don't understand why that would be true unless there are legal things about collateral ownership or something.
Thank you. Thank you, Mr. Dimon. I appreciate it. I know my time is up.
Thanks, Senator. Senator Vance Wiles is recognized.
Thank you, Mr. Chair, and thanks to the CEOs for being here. I know a few of you personally, and I admire all of you, but one of the things that I've expressed in private and also in public is my concern that the American political system is infecting the American financial system, and frankly, the American financial system is infecting the American political system. This is a graphic compiled by my staff which lists the ways in which your financial institutions have gotten involved in major political debates of the last few years. Things like the Georgia voter identification law, things like whether to lend to fossil fuel-based companies, things like guns and abortion. I should say, of course, that we all have our opinions on matters of public policy. Senator Cortez Masto and I disagree. But the difference between Senator Cortez Masto and I and all of you is that the people of our states elected us to do public policy. Nobody elected you, and so my counsel and my line of questioning is going to be very focused on this particular issue. Stay out of public policy unless it affects your core business interests, because if you don't, it's going to be a lot harder for us to see you guys as neutral arbiters and neutral actors in the American financial system. It's going to be much easier for us to see you as political actors. Now, I want to focus on a couple of issues just because I think they highlight the absurdity of this, and that will lead me to my questions. Georgia in 2021 passed an extraordinarily moderate voter identification law. 6 of the 8 of you immediately issued statements criticizing the state of Georgia to that effect, or at least your institutions issued statements to that effect. Now, I should point out that New York has a voter identification law, a much more stringent voter identification law than the state of Georgia. Did any of you issue statements criticizing the state of New York for their voter identification law? Show of hands. Let the record show that none of you criticized New York for a more stringent law but you jumped into a culture war over Georgia. I can't possibly understand why. Something that's more concerning to me, because it affects my constituents in the state of Ohio, is a lot of your approach on energy policy. We have seen over the last 18 months the consequences of reducing American energy independence. It empowers very bad people all over the world. It also impoverishes and immiserates some of my constituents and destroys their job. I'm not picking on you, Mr. Moynihan. I think you're the only bank that has a red X on every single issue. This is true of most of you. But I'm going to ask you this question about energy policy. In 2015, Bank of America committed to cut off lending by 2025, that's just a couple years from now, to companies earning 25% or more of their revenue from thermal coal mining. Now, that decision and some other decisions that have been made are raising the price of energy on Ohio consumers and imperiling the jobs of those who work in the energy sector. Why are you doing this? Did the government make you do it? And if not, why are you doing it?
Senator Vance, just to be specific, that was a statement about mountaintop removal policy. I grew up in southern Ohio where it was called strip mining back then.
Sure.
My next door neighbor was engaged in the business. And the statement we made was we would not continue to fund people who would continue to take the tops off of the mountains in the Appalachian Mountains and turn them into mines. And that was based on our assessment of the risk at the time.
So you guys have taken a number of other energy policy decisions that raise the cost of energy in American consumers. You guys have committed to a net zero standard by which effectively there are no net zero carbon emissions, and you've held your clients to that standard, saying that they need to become aligned with net zero, and we plan to be the advisor of choice to our clients in this transition. So it's not just that particular decision, Mr. Moynihan, and again, it's not just Bank of America. My point here is pretty straightforward and simple, which is that whether we achieve net zero and when we achieve net zero is a debate for the elected representatives of the American people. What kind of voter identification law we have is a decision for the elected representatives of the American people. And every time you guys get involved in these cultural war battles, it makes it harder for the American people to see you guys as neutral financial institutions, and it frankly makes it harder for us to do the same. So I will leave you with just this thought. You've heard some very good line of questioning on Basel III. I agree with Senator Hagerty about Basel III. I don't know what some of the regulators are talking about doing. I don't think it makes a whole lot of sense. Often, bank CEOs and other financial institutions will come to Republicans for more reasonable regulations, for lower taxes, to fight it back against things like Basel III. I guess my point is, if you guys are going to use the financial power that you've accumulated to go to war against the values of our voters, impoverish our constituents who rely on cheap energy, and destroy the jobs of people who work in the energy sector, why should we listen to you when you come and ask us for a tax break or for reasonable regulations? I'm one Republican who wants to have a good relationship with you, but the more you guys insult yourself into these fights, the less good that relationship will be. Thank you all for being here.
Thanks, Senator Vance. Senator Van Hollen of Maryland is recognized.
Thank you, Mr. Chairman, and thank all of you for being here today. As many of you know, I'm a big fan of CDFIs and MDIs as vehicles for getting capital into lower income areas to small businesses in places like Baltimore. Baltimore really needs that ecosystem of CDFIs and MDIs. And as interest rates go up, of course, the cost of borrowing goes up for everybody, but often it's these entities that are hardest hit. I know all of you are involved in one way or another with CDFIs and MDIs. I know Mr. Moynihan and Mr. Scharf, your banks, your institutions have a significant presence in Baltimore. Could you just speak briefly to what your commitment is going forward and whether the higher interest rate environment is negatively impacting your determination to provide support for CDFIs and MDIs?
Senator, I'll start. You know, I would say our commitment to working with CDFIs goes through all the cycles and is not going to be impacted by the rate environment that we see. We share your perspective that the CDFIs perform a service and reach a series of individuals in these markets that banks wouldn't normally be able to access. Whether it's the investments that we make directly in them. We've talked about what we've done with our PPP money, where a lot of it was given through CDFIs, specifically because they have the ability to access, again, customers that aren't comfortable doing business with banks. And so, those partnerships and those commitments will continue.
Thank you.
Senator, we have $2 billion invested in CDFI country, and that has increased from about $1.5 billion 5-6 years ago up to $2 billion. And they're very interesting in the way they can help us, including most recently, a lot of us participates in a veterans loan fund where the CDFIs can work with veterans to start businesses. And that's not unique to Bank of America. Many of us participate in. We think they can reach parts of the economy with counseling and other things that are critical to the start of a small business. Not that we don't do a good job. We have $40 billion in small business loans outstanding. And they grew 10% year over year. It's not that we all don't do a good job in that. It's just that they reach it. So our commitments, it's been there for many, many, many years, probably since they started. I just don't remember the history, and will remain solid through any interest rate environment.
Well, no, I appreciate that, and I've worked with the chairman and Senator Warner and others. I chair the appropriations subcommittee that funds the Small Business Administration and the Treasury when it comes to CDFIs. So I look forward to really pushing hard on this as a vehicle going forward. We've had many conversations over the years about late fees. Obviously, late fees and overdraft fees have a disproportionate impact on people living paycheck to paycheck. Aaron Klein over at Brookings estimated that if the United States had adopted a real-time payment system in 2007, when the Bank of England did, American consumers, and especially the folks at the lower income end, would have saved $100 billion. And so I've been very focused on pushing the Fed to adopt the Fed Now program. We have the clearinghouse system out there as well. I do just want to get a brief sense of where we are on this. As I understand, Mr. Vince, Mr. Scharf, and Mr. Dimon, your institutions have enrolled in Fed Now. Am I right about that? Any qualifications?
That's
Yes.
correct, Senator.
I'm right. Okay. And I know, Ms. Fraser, you and I had a conversation about this just a few days ago. I understand you're working through some technical issues. Is that correct?
Yes, we will be joining the system.
All right. And Mr. Moynihan, if you could give us an update on where you are, American Express.
So Bank
of America. Sorry.
American Express isn't here. If you want to come next time,
Bank of America.
fine with us. We are in the process of doing the technical work, as Jane said, and so it's just a matter of time. It's a matter of when, not if, and it's just going through the systems planning now.
All right. The more that you can do to push and get all your, coordinate this system, the better. My last question doesn't relate to banking specifically, but it does to an issue that the chairman and I have worked on over years with respect to trying to close a tax loophole on carried interest. I know that you're not all directly involved, but you're all involved in the finance system. You understand the workings of this. Mr. Dimon, if I could just ask you, do you agree that we should close the carried interest loophole once and for all?
Yes, I always have. I've been public about it.
I know. I appreciate that. I would hope that we would do that because it's just egregious that it's gone on for so long. Thank you, Mr. Chairman.
Thank you, Senator Ronald. Senator Britt of Alabama is recognized.
Thank you, Mr. Chairman. It's a pleasure to be with all of you today. Thank you so much for carving out time for this. Over the last year, we have seen a host of incredibly complex and market-altering rules come out of nearly every financial federal agency. Interestingly, 5 of our top financial regulators sat before this very committee last month and unanimously told me that they believe the U.S. banking system to be strong, while at the same time they argued for proposals that could fundamentally weaken it without providing any adequate answer to the question, why? You've seen actions, and we've seen them here from the Federal Reserve, the FDIC, the OOC, the CFPB, the SEC, many of which seem to go far beyond the bounds of their authority. Equally as concerning is the apparent lack of initiative by these regulators to understand both the qualitative and cumulative impacts of all of these rulemakings. For example, focusing on Basel III proposal. In this committee, just a few weeks ago, Vice Chair Barr said the rule will have a, quote, minimal impact on lending that banks do, end quote. Now, I'd like to say, Mr. Scharf, I heard you earlier when I was watching say that you have the most rural branches of all the banks represented here. And my question is, can you briefly respond to that? Would this proposal only have a minimal impact on Wells Fargo's lending?
Well, Senator, we are going to be commenting to the Federal Reserve. We do think there are a series of asset classes, when you look at the increases in capital that are proposed, would affect both the availability of credit and the pricing of credit in the marketplace. And additionally, as we've seen in other asset classes, when regulation like this has taken hold, you can see substantial migration outside of the regulated banking system.
Absolutely. Thank you. At the end of the day, the GSIBs play a vital role in the U.S. economy, and I don't want to diminish that. However, I do want to focus on downstream. So impacts on, let's say, Alabama, smaller financial institutions, small businesses across the country, those in manufacturing and energy sectors, individuals seeking maybe a short-term liquidity to help pay their bills. I think the list of these potentially impacted goes on and on and on. And on this point, your banks have said that by raising capital requirements by nearly 20%, the proposal would ultimately limit access to capital across the board and undermine economic growth. Mr. Moynihan, can you briefly explain this trickle-down effect? And our banks, if your banks are squeezed by the requirements of this rule, what does this ultimately mean for maybe small business owners seeking a loan, a first-time home buyer, or a small financial institution in, let's say, Alabama?
Thank you, Senator. As Mr. Scharf said, and we talked about a lot today, if you have the same capital requirements increased by 20% to do the exact same activities you did yesterday, you have to get a higher return, and that higher return will be borne by the customer base, or you'll have to leave the business. And either one of those is not good for the customer base, and it applies across the board. In fact, the idea that this doesn't trickle down through the banking system overall, we provide services to a lot of those smaller banks. Those costs of those services will go up to them. And so it has much more an impact than people think.
Right, and just quickly, I know I'm running out of time. I'd love an answer from all of you. Would it be an inaccurate statement for regulators to assume that under this threshold, those under the $100 billion asset mark, they have said, they won't feel the impacts of this? So my question for you is, will those institutions and people and things that I just mentioned under the $100 billion mark that are, quote, not affected by this, will they feel the impacts of Basel III? Just if we can yes or no down the line. Mr. Scharf, we'll start with you.
Ultimately, yes.
Absolutely. We provide them a lot of services.
Yes, the trickle-down effect is real.
Yes, it's an integrated system.
Yes, Senator, that's likely.
Yes, I agree.
Yes.
And last but not least, if this rule is implemented as written, do we risk putting the United States banking sector at a global competitive disadvantage? Mrs. Fraser, do you mind answering that?
Yes, we will. We already have an unlevel playing field with the European banks. The American banks play an incredibly important role globally in the financial system and ultimately affect the competitiveness of American companies. This is important.
Thank you, Senator Warren of Massachusetts is recognized.
Thank you, Mr. Chairman. So today, I'm going to talk about how criminals are using our financial system to move money to finance terrorists, drug traffickers, and sanctioned countries like Russia and Iran and North Korea. Our witnesses are the CEOs of the largest banks in the United States, and they deal with this issue every single day. Mr. Moynihan, you are the CEO of Bank of America, so let me ask you, if a terrorist group that wanted to attack the United States tried to move money through Bank of America accounts, do you have systems in place to identify that activity, to report it to law enforcement, and to shut it down?
Yes, we do, Senator.
Okay, Mr. Dimon, you are the CEO of JPMorgan. What about you? If a terrorist group tried to move money through JPMorgan accounts, do you have systems in place to catch it, to report it, and to shut it down?
We have extensive systems in place, but no system is foolproof.
Okay, but you do have systems in place.
Extensive.
Work on this every day. And let me just ask all of you, in the interest of time, just raise your hand if you have those programs in place. Good. I see all the hands up. Look, I believe that none of you want your banks to be used to finance terrorist attacks. But let's be clear, none of you runs these anti-money laundering programs out of the goodness of your hearts. Back in 1970, Congress passed the Bank Secrecy Act to make sure that banks don't run a financial system that is open to terrorists and drug traffickers and rogue nations. But time passed, and the crooks got more sophisticated. So after the 9/11 terrorist attacks, law enforcement discovered the way terrorists had gotten around the Bank Secrecy Act, and Congress was then called on to update the laws to cut off future access, and that's what Congress did. Today's terrorists have a new way to get around the Bank Secrecy Act: cryptocurrency. Last year, an estimated $20 billion in illicit crypto transactions funded every kind of dangerous criminal. North Korea has funded at least half its missile program, including nuclear weapons, using the proceeds of crypto crime. And Israeli officials have confirmed that Hamas received millions of dollars through crypto transactions, including, quote, large sums from Iran. Mr. Dimon, you've been CEO of JPMorgan for almost 2 decades. Can you explain why crypto is such an attractive financial tool for terrorists, drug traffickers, and rogue nations?
I've always been deeply opposed to crypto, Bitcoin, et cetera. You pointed out the only true use case for it is criminals, drug traffickers, anti-money laundering, tax avoidance, and that is a use case because it is somewhat anonymous, not fully, and because you can move money instantaneously, and because it doesn't go through, as you mentioned, all these systems have built up over many years, know your customer, sanctions, OFAC, they can get bypass all of that. If I was the government, I'd close it down.
Okay, well, that's what we're going to talk about. Because last week, federal law enforcement asked Congress to update the banking laws, saying, quote, we cannot rely on statutory definitions that are decades old to address the illicit finance risks that we face in 2023. And these law enforcement officials specifically called out the use of crypto to finance terrorist attacks. Now, the laws clearly need to be updated, but crypto lobbyists are working overtime to block any legislation. They claim crypto is special and it shouldn't have to comply with the Bank Secrecy Act, even if that means letting terrorists and drug traffickers and ransomware criminals and rogue nations move billions of dollars totally unrestricted. So I'd like to go down the line here. Maybe I can start with you, Mr. Scharf. Do you think that crypto companies facilitating financial transactions should have to follow the same anti-money laundering rules that your bank has to follow?
Absolutely, Senator.
Okay, I like absolutely. Let's go on down the line. Mr. Moynihan?
Absolutely.
Okay.
Absolutely,
All right.
positively, certainly.
Unanimous, absolutely.
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 All right, it's the word of the day. You know, we've got a way to do this. Senator Marshall and I, along with 18 of our Senate colleagues, including Senator Cortez Masto, Senator Smith, Senator Fetterman, Senator Warnock, Senator Butler, who are here right now and on the Senate Banking Committee, have a bill that would do exactly what law enforcement asks. It would extend the anti-money laundering rules that banks follow so that crypto could not be used for financing terrorist attacks or North Korea's nuclear program. When it comes to banking policy, I am not usually holding hands with the CEOs of multi-billion-dollar banks, but this is a matter of national security. Terrorists, drug traffickers, and rogue nations should be barred from using crypto for their dangerous activities. It's time for Congress to act. Thank you, Mr. Chairman.
Senator Daines of Montana is recognized.
Mr. Chairman, thank you, and thanks to all of our panelists for being here today. Earlier this year, we saw a series of bank failures, which were among the largest in our nation's history. These failures, in my opinion, were due to gross mismanagement by bank executives and regulators who were also asleep at the wheel. Instead of holding accountable those in supervisory positions responsible for missing the impending crisis, regulators have decided to put forth a host of regulations that would have done nothing to prevent the failures in the first place. In fact, every regulator I have questioned this year, hearings like this, has confirmed what we all know to be true, and that is the U.S. banking system is strong, it's well capitalized. The proposals put forth by Vice Chair Barr and other regulators will limit economic growth, reduce lending to small businesses, and for those who are able to obtain financing, they're going to see increased costs. You know, I have frequent meetings with my businesses across Montana. We are a state noted for small businesses. I hear from them firsthand about the critical need for access to capital, the concern they have with pending regulations that could threaten their businesses. I questioned Vice Chair Barr before this very committee about risk weighting and public listing requirements in the Basel III endgame proposal. Astonishingly, he claimed that small businesses would be better off under the proposed scheme than they are now, despite the fact that less than 0.1% of businesses are publicly listed and would qualify for the lower risk weighting. Mr. Dimon, could you speak to how the Basel III endgame proposal would impact your ability to lend critical funds to small business and what trickle-down effects we might expect if this were to be implemented?
Yeah, so thank you for the question, Senator. I mean, first off, these questions shouldn't wait for the NPR coming out. They should have been answered way before because it's very complex. The work should have been done. The details should have been shared. Directly, it makes those loans, we either have to charge more and it'll have a lot of unintended consequences. You know, as you know, we open in Bozeman and Billings, but we have to charge more locally just to make sure we get our return on the cost of capital. Secondarily, like the operational risk capital will increase the cost of simply holding a small business checking account or making a loan. And so all these things are a cumulative effect. It'll also affect our ability to finance your local community banks, which we often do, your local affordable housing, or the Montana pension plan. So all these things will trickle through. They'll all become a little bit more expensive, and there'll be some other unintended consequences. One, things moving out of banking, but also how we deal with customers. So I think some people will reprice, some people may drop a few customers, and also may lead to more concentration in certain ways because you're going to have to get more revenues from a client to justify the loan.
Mr. Dimon, thank you. Mr. Scharf, do you have any comments or thoughts on that as well?
I agree with what Mr. Dimon said.
Thank you. I want to shift into the issue of oil and gas investment. In this last year and a half, since Russia's invasion of Ukraine, February 27th, I've had the opportunity to travel extensively throughout Europe, where I've met with leaders in virtually all the countries that border Ukraine, particularly on the west side. Been in the Baltics, also in the Balkans, as well as Ukraine border countries. One thing I've heard that's nearly universal is that they've let the whims of the day dictate their energy policy and moved too quickly away from reliable baseload forms of energy like natural gas, coal, hydropower, and nuclear. I was struck when I was in Vilnius. They took me out to their LNG facility. By the way, when that regasification, they're these floating ships, which is parked there, it's fittingly called the Independence, as this LNG really has been key that's coming often from the United States to get Europe back on its feet to a certain extent as it relates to energy. But I asked these folks who run the LNG plant, what did you do before you were making LNG? And I had a background in chemical engineering. I was kind of curious about process and who these people are. They said, well, we used to run the nuclear plant in Lithuania. So what do you mean you used to run it? It says, we used to supply 70% of Lithuania's electricity through a nuclear plant. But in 2009, it was shut down. So why was it shut down? It says, as a condition of joining the EU, they made him shut it down, and Lithuania went from being a net energy exporter to an energy importer. And this is just a warning thing for all of us. You can't let the whim of the moment, some particular segment of a green movement at that time was very anti-nuclear. And to their credit, it was an old Russian design, Chernobyl-type reactor that needed to be changed over, but they were. Hitachi was going to build a new Japanese state-of-the-art reactor, shut the whole thing down. And they're paying a severe price for it. The need for fossil fuels is not going to dissipate in the near term. I'm very concerned the Biden administration has an all-out assault on the oil and gas industry in the United States to further their green fantasy and hallucination. We can do this the safest and the most environmentally sound way, to have a balanced energy portfolio that includes, of course, renewables and the exciting future we have in the transition, but we better make sure we think about expanding our portfolio when the world's going to need 50% more energy than it does today in the next 25 years. Mr. Dimon, can you discuss the importance?
Very briefly, 30 seconds if you can, Mr. Dimon.
Mr. Dimon, here's my question. Can you discuss the importance of having some common sense as it relates to capital requirements, lending, and so forth in the oil and gas industry?
We have to finance a transition. You need secure, safe, affordable oil and gas to do that. The oil companies are doing a great job reducing CO2. If you don't have affordable, cheaper energy, the cost on poor people, poor nations will be dramatic. We can get it done right as long as we were very thoughtful about it.
Senator Smith is recognized from Minnesota.
Thank you, Mr. Chair, and good morning to all of you, or I guess it's good afternoon now. So I'm glad to have you all with us. I'd like to start with you, Mr. Scharf. So I want to talk to you about the Community Reinvestment Act. I think that this is a really important tool for making sure that people and businesses in low and moderate income communities have access to capital and lending and financial services. And I, for one, am encouraged by the new CRA rulemaking, which I think is an important update. And I think it makes some thoughtful changes to realign the CRA with its core purpose and to give banks and financial institutions clear direction on what activities qualify for CRA credit. So, Mr. Scharf, could you tell me how you assess this final rulemaking for the CRA, and do you think that these changes will better enable banks to meet their CRA obligations?
Senator, I very much agree with your sentiment of both the importance of CRA and the need to make changes in existing CRA legislation to ensure that the ultimate goals are actually achieved through the actual legislation. I think when you look at the changes that have been made, there's certainly many items that are taken into account which are directionally supportive of what I just said.
Mm-hmm.
We've given some comments to the regulators about some of the specifics that we would like them to just reconsider as they work towards that goal. But directionally rethinking CRA and doing it in a way that all the regulators come together is extremely helpful.
Thank you. I agree with that. I think having everybody being on the same page was an extremely important part of this as well. Another thing that I think is true is that these updates to the CRA regs were decades overdue. So do you think that it would be helpful for regulators to update these rules more regularly to kind of have a more rapid cycle? I'm not talking about changing rules all the time, but I'm saying learning from our experience and your experience to make sure they're working well.
I mean, Senator, yes, it absolutely makes sense to relook at these things and make sure that they're having the intended consequences, and just at the same time realize that all of those changes then filter through a lot of work that we have to do, and so just striking that right balance is also, I think, very important.
Great, thank you. Mr. Solomon, good afternoon. It's good to see you. Many of us are giving thought to how AI, artificial intelligence, is being deployed and how we should be setting guardrails for its use, and understanding that AI has been in use for many years. I think it's true that generative AI has gotten a lot of attention over this last year, and both for its capacity and also for the limitations that have been on full view. Earlier this year, Mr. Chair, the Bing AI chatbot urged a New York Times reporter to leave his wife. And just last week, it was reported that the Amazon chatbot experienced, and I quote, severe hallucinations and leaked confidential data. So my question for you is the leader of Goldman Sachs is, how do you see using this? I know that you probably have been using our AI tools for quite a long time, but could you talk a little bit about how the generative AI projects that you're working on, how you see these being deployed internally, and how you are thinking about the appropriate guardrails?
Thank you for the question, Senator. Obviously, it's something we're very focused on, and as you highlight, there are super offensive productivity things that can be done with the technology as the technology accelerates. As you point out, we've been using artificial intelligence in our business for quite some time, but these large language models accelerate your ability to use very, very highly paid people more effectively with clients by giving them access to information and giving our clients access to information that is sorted and organized more quickly. Those are the positives. On the negatives or the defensive, the technology can obviously be used to disrupt activities, to disrupt markets. It falls into our category of thinking about cyber protection and guardrails. And so we have an enormous amount of focus in thinking through how these tools can be used to attack our systems, our platforms, et cetera. I think it's the acceleration of this technology is going to continue. The pace is quite robust. And I think there are opportunities, but we also certainly have to be vigilant to recognize that there are things that are going to develop that we can't see, and we've got to make sure we have the right protections in place.
Thank you. Ms. Fraser, I just have a couple seconds left. You and I spoke about this a little bit recently. Tell me how you think about this from Citi's perspective.
So about 4 years ago, we put some principles in place for how to use AI, and topics such as fairness and transparency in how it's used, making sure that you can understand and trace the different algorithms that are in place, elements like that, and making sure that there is human beings governing this, and make sure the protections are there so we get the opportunities realized from it, and also use it to defend against the threats.
Thank you.
Thanks, Senator Smith. Senator Fetterman from Pennsylvania is recognized.
Thank you, Mr. Chairman. Thank you. All right, Mr. Moynihan. Back in 2008, the Bank of America, your bank, didn't have enough capital to cushion the bad investments decisions that you made, and you had to be bailed out. And then in 2023 of this year, the Silicon Valley Bank didn't have maintaining enough capital and had to cost over $20 billion from the FDIC. So let me ask you, should we believe you that you have the Batman, we got this kind of an issue? Or should we able to have intervention to adjust this?
Well, Senator, I think since the financial crisis, this body, along with Congress and the President, passed the Dodd-Frank Act, and there have been, which changed the capital rules. There was an adoption of further Basel standards. On top of that, there's been 13 stress tests, if I've got it right, each one of those more severe. And so even in the last 5 years, we probably have 10, 15% more capital required for under those tests. So I think there's been a significant amount of regime change made. The question is, for the institutions that failed early this year, is that none of them are captured with that scrutiny. And our view was that as a group that had to go in and do two things. One, try to keep them alive long enough so it could be resolved. And secondly, this week, soon we'll cut a check of $2.1 to $2.2 billion to the FDIC to pay for the cost of the cleanup. And our company, along with all of us, our view is that these capital rules aren't really going to address that. And there have been many capital rules applied to these institutions and the 30 stress type banks which do apply to that. And that's why you saw us to be a source of strength earlier this year.
Oh, yeah, well, if you felt that, we all supported those kind of changes after the crash, and then how come we have what happened at the Silicon Valley Bank now some 15 years later, and if there wasn't the kind of intervention, it would have called another kind of a crash. So have we got it right yet? Should we have to make any more changes? How are you okay with this idea that a relatively small bank, especially compared to the size of all of you in front of us today, could cause a crash system-wide unless that the president had to quickly intervene and make sure that we address this? Any changes? Anything else? Or that it's okay to worry that a small bank could actually imperil our entire financial system?
I think 4,000 banks have failed over the course of time. That's what the FDIC was created to help. And they've been resolved as a
But have any of them almost crashed their entire economy or the financial system?
In 07, 08, the system was outside the system in addition to that. So many of the people up here were not bank holding companies at that time. And that was the invention of the broader purview of the banking regulatory net, the invention of the FSOC we've talked about, the invention of stress testing, the invention of all these things and Basel rules to move to a advanced methodology using models and other things to measure risk as opposed to standardized methodologies, which is what we're going back to now. All that was made to change the system. Silicon Valley didn't threaten the U.S. economy. It could have been resolved, and it was resolved.
Well, why did the president, act so swiftly if there wasn't such a concern? That's amazing that you can get, on the phone and act so quickly for that kind of money. Like, if there really wasn't such a significant risk. I mean, I wasn't read about the other 4,000 banks that crashed that, required the president to react in such a swift manner.
You'd have to ask the people. We didn't think that all that could have been resolved differently. Many of us that got involved with the First Republic transaction, the deposits we put in, but you're going to have to ask the other people why they did what they did. It's not us.
Okay, so but again, no changes are necessary, despite now that we seem to have this enduring kind of a risk that bad behavior or bad investments could actually crash, our whole financial systems.
There were specific things that happened in Silicon Valley Bank that should be addressed by regulations. And the most important one is excessive interest rate risk. That's got nothing to do with Basel III, the issue here. And I think the American public should know that banks pay for the FDIC. That's not government money. That is a mutual company, and I would love to take it over and take it off your hands and manage it ourselves.
With all due respect, Mr. Dimon, I really think it really matters, who's paying for it, but the fact that anyone has to pay because of these choices are necessary. Now, my chairman, could I have, and actually Mr. Dimon was next to my question.
Quickly.
Outstanding. All right, so Mr. Dimon, you claim that the capital requirement and that will increase costs and reduce lending. Chase done $5.7 billion in share buybacks and $9 billion in dividends so far this year. So wouldn't it be easier just to kind of hold on to a lot of that money and lend it out? Or why would you want to give it away to the shareholders and other things like that, or buying back your own stock?
It is the shareholders' money, and we do all the proper lending we can and should do. It will reduce the profitability to a bank of doing the business, and I don't think you should be asking people to do stuff that's unprofitable for their shareholders. That's more like a charity. There's tons of that. Happy to talk about that in more detail.
Thank you, Senator Fetterman, and the committee will take under advisement Mr. Dimon's proposal to take over the FDIC.
Yeah, I would love to, if there was more time, because I would love to have you explain why we should support, Democrats should have support Nikki Haley for president, but I don't have the time.
Thank you, Mr. Fetterman. And while I like your ideas on SSI, Mr. Dimon, I need to think more about FDIC. Senator Warnock from Georgia is recognized.
Thank you so very much, Mr. Chair. Before I get to the question that I set out to ask, I have to respond to the senator from Ohio, not the chair, who apparently takes great umbrage to the words or the letters sent by the leaders of these institutions responding to the voter suppression bill that was passed in Georgia. I know a little something about voter suppression in Georgia. Today is, in fact, the one-year anniversary of my election in Georgia. But my election should not give people the false impression that there's no voter suppression in Georgia. It should not give us any misunderstanding about how bad a law SB 202 actually is. In fact, I had to sue the state of Georgia because at the beginning of my runoff a year ago, they decided that folks wouldn't be able to vote the first Saturday of the runoff, claiming that this was the clear letter of the law. You couldn't vote a couple of days after a holiday, that holiday being Thanksgiving, and a day that used to honor the anniversary of Confederate General Robert E. Lee. And so I had to sue them and then appeal again and again just so Georgia voters could vote. So I think that people in your position do have a corporate responsibility, and I hope you will certainly feel the freedom to lean in the places and the spaces where it's necessary. And in that vein, I want to ask you about the Safer Banking Act, legislation recently considered by this committee on cannabis banking. Many of your banks have lobbied for this bill, and the American Bankers Association, of which you all are members, supports the bill as well. I'm going to ask you to raise your hand if you support the Safer Banking Act. None of you support the Safer Banking Act. I'm going to ask you a question. Raise your hand if you support the Safer Banking Act.
Senator, we all support the intent of it. The problem is it doesn't fix the problem, and that's it. So don't take our non-essentials.
Let me ask my next question. Please raise your hand if you believe passing the Safer Banking Act will reduce the racial wealth gap. So this is interesting, and so we should have some conversation about this. The American Bankers Association, of which all of you are a part, writes that this legislation will provide, quote, legal and regulatory clarity for banks, and it would help facilitate access to financial services. My question is legal and regulatory clarity for whom, and who are we making safer? Since the war on drugs began over 50 years ago, communities across America have been decimated. They've been hollowed out. Communities all across our country in the wake of the explosion of mass incarceration, making us the mass incarceration capital of the world. Missing bodies and abandoned buildings. The war on drugs has been a war on communities of color. I want to be clear that I am open to safer banking and more regulatory clarity around cannabis, but my fear is that if we pass this bill right now, then your banks and other powerful voices will be missing in action when it comes time to address the broader harms of the war on drugs. And so I support safer banking. You all seem reluctant to say whether you support it or not. I'm concerned about equity and whether we will get that in the process. So let me ask you this. Will each of you commit to ensuring your banks will uphold the standards that would, standards in the Community Reinvestment Act, that is, which we'll soon have another opportunity to address. Will you support standards to increase equity as we move forward, perhaps on safer banking? Mr. Scharf?
Yes, Senator.
Mr. Moynihan?
Yes, sir.
Mr. Dimon?
Yeah, we support the intent, but I would have to see the actual words in the actual law.
Would you support efforts to be intentional about supporting equity and addressing the awful impact of 40 years of the war on drugs, which in many ways has been a war on black and brown communities?
Yes, but I would, before I agree to something, I like to see the actual detail down to the last word. Okay.
Mr. Fraser. Ms. Fraser, I'm sorry.
Yeah. I think, Senator, Mr. Dimon, absolutely support the intent. The details matter. We'd look at it and work with your office if we had concerns.
Mr. O'Handley.
We support the intent.
Mr. Vince.
Similar to my colleagues, we would want to see the detail.
Mr. Solomon.
I would want to understand the detail more. We will continue to do things to support investment in underserved communities.
Exactly the
Gorman.
same.
Thank you so very much. I think this is critical. There's nothing in history that suggests to me that if we leave behind these communities that are marginalized, as we make banking safer for powerful banks, and people in positions who sit here and who sit there. There's nothing in history that suggests to me that we're going to go back and get those folks. And so I hope that I can continue to engage you and that as good corporate, responsible citizens, you will take an active interest in this, recognizing that it's not only the right thing to do for the future of our economy, it's the smart thing to do. Thank you so much.
Thank you, Senator Warnock, and thank you for setting the record straight on the Georgia election law.
Thank you.
Senator Lummis.
Thank you, Mr. Chairman. Welcome. There's been a lot of talk today about Basel III. We know what it means for your banks. I'd like to explore for a little bit what it means for small community banks. Wyoming and other rural states rely on small community banks, and while the capital requirements apply to the systemically important banks, I would like to know if there are additional impacts on smaller community banks and their customers. So I'll address the question to Mr. Dimon and then ask anybody else who wants to take a swing at this to weigh in as well.
Yeah, so thank you, Senator. I think the smaller community banks would say they're not directly affected by this, but since a lot of us up here bank those banks, we bank their retirement funds, we bank their cities, we bank other small businesses, we bank local schools, cities, states, hospitals. It will trickle down to higher costs to them in one way or the other. It also changes the competitive landscape. It may, in some ways, make it harder for them to compete with us, as opposed to less hard.
Would anyone else like to take a swing at that one? Thank you. Americans interact with a financial institution through their banks, and they save, like, for kids' college education with mutual funds and protect their families with insurance. Can you explain why ultimately these changes will impact families planning for the future? So my question is, what are the impacts of Basel III on pensions, mutual funds, insurance companies, and other users of derivatives who hedge? Now, hedging in my industry, agriculture, is very important. So I'm interested in the implications for hedging and the other entities I mentioned. Perhaps Ms. Fraser, would you address this?
Yes, hedging plays a very important role for protecting against risk and helping mitigate risk, particularly when we're in very volatile times at the moment. It's important for providing stability and income flows. And commodity hedging is a critical piece for any farmer in America. So the increase in capital associated with the Basel III rule will have an impact on the cost of that hedging and potentially even the provision of that hedging. And as you say, it permeates many different parts of our economy and society. It's not just for the most sophisticated players.
I want anyone who's interested in responding to this question to take it. One of the things that my staff observed is that one of the most poorly thought out parts of Basel III is how public listings are used as a proxy for counterparty risk in derivatives, counterparty credit risk in derivatives. So it looks like this will harm, at a minimum, nearly 70 million households who invest in mutual funds. I'd like to know if you agree with my staff's concern and how we might address that. And this is for anyone who wishes to take it. Yes, sir.
It's a very crude measure of risk and doesn't reflect the fact that some of the largest and most sophisticated companies in America are public. So it's just putting in one basket, saying that by definition, if you're not public, and if you look at the trends, in fact, fewer and fewer companies are public these days. That's a whole different kind of debate that we can get into some other time, but it's a terribly crude measure.
Do you know why they chose to make public versus private companies different and treat them different in terms of using them as a proxy for counterparty credit risk in derivatives? Anyone? Well, we don't know either, so we're all in the dark. Okay. question. Why is it, and this again is for anyone who wishes to weigh in, why is it so important that the United States have a regulatory framework that allows our financial institutions to compete on the global stage? As we see the rise of China asserting the influence of the yuan all over the world, help me understand why we have to stay competitive.
I speak as an immigrant to the States. America plays a critical role around the world in terms of supporting supply chains, in terms of the risk management tools it provides, the stability it provides to populations all over the world. The investment flows, we account for over 50% of all of the capital activity and investment activity in the world. That is a strategic asset for America. It's something we should be incredibly proud of, and it's something that we need to defend.
Anyone else?
Okay,
Oh, yeah.
anybody else want to answer? Sure. Okay. I think when you're next to the last, people are getting kind of tired. So.
Thank you so much.
Thank you. Thank you for the patience of all of you. Senator Butler, the newest member of this committee, and sorry you have to sit there.
And number 100. When you were number 100, you stand between the panelists and lunch. So I appreciate very much the time that you all put into talking with me, knowing that I was going to be the last person to ask you questions. But because most of you have a significant footprint in the state of California, I thought it important on behalf of the 40 million California residents to sit here the entire time and represent their interests across this industry. I'm glad our ranking member made his way back as the newest member of the Senate. I'm still getting to know my colleagues, and I wanted a ranking member to know that I do agree with him on a key point that he made in his opening remarks, and that is the majority of the American people who are watching this broadcast, particularly who are still watching, are not talking about nor have any interest in Basel III endgame. They are talking about fairness and fees and affordability. And so that is where I want to land my two questions. I want to, and it's honestly not to pick on anyone, but really in the space and intention of moving things along. I want to pick up on Senator Smith's point around algorithms and algorithmic deployment. Ms. Fraser, you and I spoke about this as it relates to customer account closures. We talked specifically about the November 5th New York Times article in which Citi was specifically mentioned, a customer of yours who owned a bar and who was making bar-like deposits, end-of-day cash deposits in round amounts so that they could actually keep petty cash on hand to be able to make change at the bar, and found themselves the victim of an account closure due to what the algorithm determined was suspicious activity. Can you talk more about the process that you have deployed across Citi to give customers confidence that when you are doing your due diligence as a significant global investment institution, when you are doing your due diligence to provide and enhance national security, how do those American people who are still watching, who are still listening, who will hear this back, how can they have confidence that their credit isn't going to be negatively impacted, that you're going to return their whatever remaining balance that they may have on time in a way that they can actually get their bills paid due to no wrongdoing of their own?
Senator, thank you very much for the question. Thank you also for sitting through the entirety of the hearings today. You raise a really important point. I think all of us want to protect our customers. There's a tremendous amount of fraud. There's cyber probably keeps us awake at night. We want to do a good job for our customers. We want to look after them and enable them to live their lives and their financial lives securely. We have money laundering requirements that are very significant, in which we're not allowed to go and then tell the customer why it is we've closed their account. And I think all of us appreciate how frustrating that is for our customers, but we must follow the law. You and I have also talked about when it's found out that a customer's account has been closed in error or for some other reason, or there's been fraud blocks, how do we then help them recover their funds quickly? And that, again, I think there is no bank CEO on this table that does not want to help a customer to do that. And we're very happy to follow up with you on what are different ways that can be achieved. Thank you.
Thank you, and thank you for extending that opportunity to continue to figure out ways that this body can act to protect not only California customers, but people who are banking with your institutions around the country. My last question, Mr. Dimon, you and I also talked about this. As the representative from California, it is critical that I represent those voices on affordability and home affordability. In particular, your institution has done an incredible amount on this issue, and I want to applaud and recognize you for that. On the other hand, the other issue that I raised with you is just a concern of this intersection of both a declaration and a support for investing in affordable housing and making mortgages more affordable for low and middle income families, and the practice of financial institutions in buying real estate development purely for the purposes of putting it up for rent. Those two things seem to be in opposite and in contrast to me. And there's a report of JP specifically in California about this behavior. And I'd love to give you the opportunity to talk to Californians about how you are meeting both of those obligations, the obligation to provide more affordable housing, help to create more access to the American dream, and at the same time, buying more and more single-family residential properties that where they are going to be only available for renting.
Right. So thank you for
Mr.
the
Dimon,
question.
be brief, if you
Yeah,
would.
thank you for the question, Senator. Love affordable housing, do a lot of it, as do a lot of the banks up here. We can make mortgages much lower cost for lower size mortgages. I've been dying to work on that for 10 years now. I think that you're referring to an instance where we financed a company which is building homes, and it's, I think, 200 homes for rental. Remember, rental is appropriate for some people. And so I understand your concern, and I'll look into the specific thing, but building more homes is good for affordable housing.
Thank you, Mr. Dimon. Senator Butler, thank you. Thanks to the 8 of you for joining us today. For senators who wish to submit questions for the hearing record, those questions are due 1 week from today, Wednesday, December 13. To the banks, please submit your responses to these questions for the record 45 days, no more than 45 days from the day you receive them. Thank you again. The hearing's adjourned.